And welcome to our Trading Success Summit. I'm Ken Calhoun from TradeMaster. I'm really pleased to welcome Tom Sosnoff, Larry McMillan, Steve Nissen, Jeff Gibby, and myself, Ken Calhoun, presenting in today's event. Can everyone hear and see the screen okay? Just want to do a quick audio visual check. Can everyone hear and see the screen okay?
Testing 1 2 3.
Okay,
testing 1 2 3.
Let me go ahead and turn it over to Tom Sosnoff. I'm real pleased to see Tom here. He's the founder and co-CEO of Tasty Trade, Thinkorswim, and Tasty Works. He's one of the aces in the deck. He really knows his stuff, one of the more important figures in the industry. And it's a real pleasure to have Tom with us today. Let me turn the presentation over to you.
Thanks, Ken. Can you, let's see, can you hear me? Testing 1 2 3. Can you hear me?
All right, Tom Sosnoff, you're up. And can everyone please let me know if you can hear Tom speak when he gets on? He should be on here momentarily. Can you folks hear Tom? Just doing a quick check.
Testing 1 2 3.
Testing on my end.
Testing 1 2 3.
Well, welcome aboard, Tom Sosnoff.
Thanks, Ken. I can hear you just fine. Can people hear me? Oh boy. Okay. Let me just see something really fast. Make sure everybody can hear. I apologize. I'm not sure exactly what the issue is, but my microphone seems to be working. Ken, can you hear me? Again, I apologize for the delay. I'm just not sure if anybody's able to hear me. So, which is super weird, but let me try one other thing. I will call in really fast just to make sure. I apologize again. Just to make sure that I'm not talking into a dead screen.
Okay, I can hear you now. Thanks.
Oh, you can?
Yeah, sorry. We're moving to, yeah, hey, Tom, I really apologize, sir. We're moving to Zoom momentarily, but for now we're still on GoToWebinar. But thanks so much, Tom Sosnoff, for being here. If everyone in the industry was a card in the deck of cards, you're an ace. So thanks so much for being here. You've done so much for the industry, and I sincerely appreciate your headlining today's event. What I like best about your software is it helps people visualize trade parameters. So take it away, and thanks so much for being here. I appreciate it.
And thanks for having me, Ken. I'm glad to finally. Yeah, I know you can hear me, so I'll start. I don't know if there's and obviously I appreciate everybody being on today. Thanks for taking some time out of your Saturday morning. You know, we have there's a bunch of different topics I think we can focus on today, and I was trying to think of essentially, you know, where can we get the most bang for a buck in the next 30 minutes or so. Ken, what do I have, about 30 minutes?
Yeah, that's right.
Okay, so I got about 25 or 26 minutes left, so let me just rifle through this as quickly as I can to get as much in there. One of the things I like to do is
Tom, I was going to say, Tom, you can go over if you want, because I'm up next and I'll cut my time short. You're much more important than I am, so feel free to go over another 15, 20 minutes if you want.
No, it's fine. I don't want to. I'm good. Don't worry. We'll be good. I got the game that we've been playing because it's going to introduce a lot more products. It's going to introduce a lot more markets, and it's going to make the world of tokenization and strategic finance that much more all-encompassing. So, what I thought would be kind of an interesting discussion today, and something that's a little different from, the typical discussions, is to kind of focus on a little bit on some of the new products that are out there and some of the different ways to play some of the new products that are out there, and to show you how on a single platform we can integrate, all these new aspects of both content, strategy, and product into kind of the mix, so you can get an idea. Because in the future, looking forward to the next, I think looking forward to the next 10 years, and Ken, and I'm sure all the other speakers that are coming on later, and it really is a great, cast of characters, and it's a who's who of some of the real talent in this industry. I think you're going to realize that the future is all about what I call capital efficiency. The people that are going to have the most options, the people that are going to create the most wealth, the people that are going to understand this the best and thrive and have the most success are going to be those that understand both optimal mechanics and capital efficiency. Capital efficiency is just meaning that we all have a limited amount of capital, and our ability to deploy that capital into the most underlyings and the most strategies to give ourselves the most diversification and essentially play law of large numbers is probably from a strategic side, the most important thing we can do. So I thought I'd start off today and talk a little bit about digital assets. And the reason for that is because, I've done, I don't know, if I was to guess, I'd say I've done 1,000 seminars, webinars over the last 20 some odd years, 22 years. And every time I try to do some variation of something that we've done before, but to make it different. And every time I try to give a different takeaway. And I think today is no different. I'd like to give you some takeaways that I really haven't presented before. And I think that that's super interesting. So the reason I'm going to go into the area of a little bit of decentralized finance is because A, it's open 24 hours a day, 7 days a week, and B, it's interesting and most people don't talk about it, especially most boomers, especially my generation of traders, which is not necessarily old school by any stretch, but just didn't grow up in a decentralized world. So one of the neat things about Tastyworks, we're the only brokerage firm in America that supports all products: stock options, futures options, and crypto. And crypto is open 24 hours a day, 7 days a week. So if I go to the crypto interface on Tasty, which I'm on right now, I'll show you right here. This is Bitcoin, this is Ethereum, and this is Polkadot. These are just three of the underlyings that I like to mess around with. And if I wanted to, for example, it's open right now. It's up, crypto's up a little bit. It's sold off pretty hard on the last couple of days on Wednesday, Thursday, Friday of last week. I'm sorry, Thursday and Friday after it made a high on Wednesday. But for example, if I wanted to, just as an example, to buy, let's say $500 worth of Bitcoin right now, and it's 11 o'clock in the morning on Saturday morning, and I'm Chicago based, I just type it in, click on it, boom, filled. So the idea that the cash markets are open, the tokenized cash markets are open 24 hours a day, 7 days a week, that's cool. It's like I just bought some Bitcoin if I wanted to buy some Ethereum, and I'm just showing you this because I'm just giving you an idea of what's open. Bought $500 of Ethereum if I wanted to buy $500 of Polkadot, which is a digital asset that I like to trade. I just bought all three of those, just to give you an example of, this is what 24-hour trading is, and this is what tokenization is going to bring to the marketplace, and this is where we're going to be at in the next couple of years, virtually around the clock, 7 days a week. Now, the problem with crypto at the moment is it's not strategic. It's black and white. That means it's a buy-only product. You can't short cash crypto, you can't borrow, and there's no options on it. So it's effectively a non-strategic product, but it has really good characteristics in that it's liquid and it's open all the time. So I just wanted to show you that this is built into the platform. Also on this platform, because I'm going to show you all the different things that kind of equate, if I wanted to trade, for example, this is the micro Bitcoin futures right here. And this is a CME product that's /MBT. This is the equivalent of 1/10 the size of a Bitcoin product. So where I just traded $500 of Bitcoin, this product here is 1/10 the size of a $61,000 coin, or it's $6,100 worth of Bitcoin. But it's leveraged at about 50%. So it's more capital efficient than trading in the cash market. You see right here, if I was to buy one micro Bitcoin contract, it'd be about $3,500. So it's a little bit more It's about 55% or something of the underlying. But that's still the only way to trade the crypto markets in a purely leveraged sense is to use the futures. And really right now, the only liquid future is the micro Bitcoin for customers. And it's about a $6,000 product. Is there any difference between buying $6,000 in a future and spending $6,000 in the cash market? Nothing. Absolutely zero. There's no difference, except you only have to put up 3,500 instead of 6,000. So you effectively save yourself about $2,600 in cash that you can use for something else. That's the beauty of it. That's the beauty of using the future in this case. But the nice thing about Tasty is from the same interface, you can trade the micro Bitcoin futures. And I'm just showing, this is just a graph of it in case you're not familiar with what Bitcoin's done recently. These are the last 2 days on Thursday and Friday. It's not, the futures aren't actually open today. So the cash market's open, the futures market's not open. But what I want to show you is that the cash markets, you have to pay for everything, no margin. The futures markets is leveraged to about 55%. But what's also interesting is that we are now entering here, this week, we launched our first ETF in the world of digital assets, a Bitcoin ETF called BITO. Let's go over here, trade. And so this is the new Bitcoin ETF, BITO. You see it traded 11 million shares on Friday, which is a nice number. That's good. That's really good volume. The IB rank is irrelevant right now because it just came out. It's a brand new. But you can see it's trading with an 81 or 82% volatility. When it was launched earlier this week, it had about a 91, 92% volatility. The interesting thing to know about digital assets, which, by the way, the only ETF in future right now is Bitcoin, because Bitcoin is the largest digital asset with about $1 trillion market cap. But the reality is that, you know, Ethereum's pretty big with like almost 400 or 500 billion, and then the other ones fall off. It's about 2.5 trillion in the entire space. But what's really interesting is we're just nibbling. We're just you know, putting our toe in the water with respect to product. All of these underlying digital assets are highly correlated. Now, Tasty has 18 of them on the platform, and we're adding 3 more next week. So we have 18 today, we're adding 3 more next week, we'll be up to 21. And so we're the only firm that has really digital assets on the platform, and then we'll have as many as 21 as of next week. And we're the only ones that offer digital assets and futures. And I'm telling you that because it's important to understand the capital efficiency of futures as they relate to digital assets. But they're all highly correlated. They're all in the 70, 0.7, 0.8, and 0.9% range as far as the correlations go. What's important to know about digital assets is when they go down, like on Friday, the volatility collapses. So the volatility this week came in 10 percentage points. If crypto assets go up and digital assets go up, then volatility expands because the velocity of risk is to the upside. But the most important thing about the launch of this BITO last week is we now have Bitcoin options, which we truly didn't have before. So now on the platform, and I can open up November options. So now on the platform, and you see this is really good volume, trading in the hundreds of contracts, and just in, I think in like 3 or 4 short days, the open interest is up into the thousands, which is nice. Hey, it's just a brand new product, so it's just starting out. But if we look at the volume, it was still great on Friday, a couple hundred contracts. The markets are okay. They're not best. They're about 5 or 10 cents wide. They need to get tighter. Eventually, they'll probably get down to about a nickel wide. But Bitcoin is very volatile, so it's hard to have an 80 IV with a 80 implied volatility with, you know, penny wide markets. But what's important is on Tasty, you can see 27 days to go to expiration in November, and the expected move in this particular product is $6.40. It's only a $40 product, so it's got a 15% expected move in just 27 days. That's a big move. And I'm just starting to build a little position in here right now because it was hard to get some fills early this week. But one of the neat things is that we now have the ability to trade cash crypto, futures crypto, and also now options on crypto for the first time. As this happens, what's essentially what's in the process of taking place is we are going to make the marketplace far more efficient for individual traders to be able to participate in the digital asset space. And the digital asset space is growing like crazy. And it's also just incredibly interesting because it's a little mind challenging. It's something different because crypto assets trade differently than equity assets. They're not highly correlated to equity assets, but they do have about 4 times the implied volatility of equity assets. They have about 4 times the expected move. So they're actually a very important part of every portfolio. And how do you learn about them? You trade them. So the best way to learn and the best way to get exposure is to do something. So how do you do something? Well, you find either you can buy or sell something in a black and white or static environment like the cash crypto. You can trade a future if you want to be more speculative, which go 24/5, or you can put an option position on and sell some premium, or you can reduce basis against a cash instrument. So it's like, it's okay, this is all super cool because just think about this. On 100 shares of stock, the notional amount here is about the equivalent of $4,000, right? 100 shares of a $40 stock is about $4,000. So when you start to think about, okay, now let's talk capital efficiency. So $6,000 worth of a future is $3,500. The equivalent notional size of an ETF is about 4,000, of which pretty soon you only have to put up a percentage of that. And then the cash market's a little bit higher. But you can start to, as far as how much capital is required, but you can start to see, oh, wow, this makes sense. Now, if I want to do something with defined risk, then it's only the amount of, it's risk defined is essentially the buying power reduction. So for example, right now, if I wanted to get long Bitcoin because it sold off 10% last week, I could buy the cash market like I just did. I could wait till Sunday night and trade the futures market if I want to. Or, okay, I can wait till Monday morning and I can sell, for example, this closed at 39.51. I might want to sell let's just say a 35 put. And if I sell a 35 put, my statistical chance of success, you see this delta right here is 26. That means the statistical chance of closing under this number is right around 75%. It's right the inverse of 75%. So closing above that number is 75%. It's the inverse of that. So it's like about 23, 24%. So it's about a 75% probability of success. Well, the cool thing on Tasty is we also show that number to you right down here. We call it POP, probability of profit, 72%. And then over here, we show the P50, which is the probability of making 50% of max profit, which is most of the time going to be higher than the probability of making a penny in profit. This is the probability of making 50% of max profit, which in this case would be $70. And this is another way of notionally getting long with a high probability of profit. And the only difference is, okay, that of buying Bitcoin outright is you can make less money, but you have a higher chance of success. So now you have all these strategic options at your fingertips. I'm not saying one is better than the other. I mean, this obviously has the highest probability of profit, but the other trades have a lower probability of profit, but you have more upside potential. So one's not necessarily better than the other if everything's efficiently priced, but you're starting to understand now, hey, I now have options. I have strategic options. So let's just say, for example, you know what? I don't want this because this is cash secured and I can't make enough money. So I'm just going to buy the 30 put. Now I'm short a $5 wide put spread. Now I only have to put up $4, the $5 wide spread minus the $1.08 in credit that I'm collecting. So now I only have to put up $400 to trade this, and I have the potential to make $1 or a 20% return in 27 days, with the chance of making 50% of that at 78% and a pop of 70% of this trade. Now, all of a sudden, the strategic investor and every one of you should say, hey, you know what? That's kind of a pretty cool lesson because I didn't realize those are all the same trades. Take a look at this for a second. If I go to one contract here, the delta on this is 17. So the way to figure out how much Bitcoin, you're essentially long is, just remember that if the delta was 100, that would be the equivalent of, let's just say, of $4,000 worth of Bitcoin. If the delta is 17, let's just call it a little less than 1/5. So basically, this spread here is the equivalent of probably about $750 worth of Bitcoin. Now you're getting to the point where you're like, wow, this is kind of cool. So if I sell this spread, if I sell this spread, I'm long the equivalent of about $750 worth of Bitcoin. If I just sell this naked put, the delta is 25, and that means it's about 1/4 of 4,000, or I'm about long the equivalent of $1,000 worth of Bitcoin with a high probability of profit. So trader A might say, hey, you know what? I have plenty of capital in my account, so I want the 72% probability of profit, and I want the 25% potential return on capital. I want the 81% probability of making 50% of this trade, and I like that risk reward wise. Trader B says, hey, you know what? I have less capital, so I'm only going to put up $400. I'm going to have the opportunity to have only $700 worth of equivalent notional, and I'm willing to take my chances. I'll make less money, but I have to put up less money so I can use money in other places. Trader C says, hey, you know what? I don't like that trade at all, so I'm going to go over here because I want all the upside in the world, and I'm just going to buy a futures contract. And I'm going to put up $3,500 and control $6,000 worth. And then Trader C said, and then Trader D, says, you know what? I like both of you guys, but I'm going to just buy a little crypto. I don't want to take that much risk, so I'm going to buy $100 worth of Bitcoin. It's open right now. Take a fill. And I just bought $100 worth. So all of those options available to everybody through a single platform. That's what we call the facilitator of risk. The facilitator of opportunity, VITO. So one of the things that I think is so important, and one of the things that I think is going to be this is going to be essentially the next generation of finance, is I have no idea whether Bitcoin or digital assets are going up or down. I sold out a lot of my digital assets last week because I thought they got too extended. But I have no idea whether Bitcoin's going to 75,000, 90,000, 100,000, 150, or back to 20,000. Nobody does. That's the beauty of random markets. Nobody has a clue. Literally, nobody knows anything. Nobody knows what the demand is going to be going forward for Bitcoin, for Ethereum, for Cardano, for Polkadot, for whatever else it is. Nobody knows. Nobody knows if IBM is going to go higher next week. Nobody knows if Tesla is going to continue its rally. Nobody knows what's going on. Nobody knows what Facebook earnings are going to be next week. But what we do know, and what we do understand, is that we can look at a specific asset class, like digital assets now, and instead of being one-dimensional, instead of saying, hey, you know what? I don't want to open an account with an overseas crypto firm that I've never heard of, and I'm nervous about giving them my credit card. I don't want to take a chance with, I don't want to go to a place like Coinbase or something, even though they have a good crypto platform, because you can't do anything else there. I want to integrate digital assets inside my portfolio with everything else I have, with all my option positions, with all my stock positions, with everything else that I do in the world of finance. And I want to be strategic about it. I want to trade futures. I want to have the option to trade futures, the option to trade ETFs, individual stocks. Let's say for whatever reason, you know what, Bitcoin, this BITO is down a little bit, but Riot's actually down a little bit more. Here, just take a look. Well, you can't really tell from, doesn't look as, this stock really hasn't gone anywhere, but it's essentially, it's a blockchain stock. And so it trades, like a 75 to 80% correlation with digital assets. And maybe you like the volatility in here a little bit better. I mean, maybe this, because it's 101 as opposed to 80, is a little more attractive. This has almost a $5 expected move in November, and it's only a $28 stock, as opposed to the ITO. Getting back to this, which has an 81% volatility. It depends. All I care is that we give you the opportunity to use whatever underlying you want to be able to know quantitatively what your probability of profit is, what your probability of making 50% of max profit is, what your delta equivalent is, and even even in some cases, what's crazy interesting, like if I went to Riot, for example, and I have no position on in Riot right now, and I went to Riot, I said, you know what? I'm going to sell these same puts for, let's say, the 25 puts. What's kind of neat about this is, okay, so I sell an out-of-the-money put. I have a 70% probability of profit. I have an 81% P50. That's the probability of making 50% of max profit. By November expiration, the expected move is $5.60. So I'm just a little inside of my break even there. But how much is this going to affect my position? Well, what's cool here is that we show your beta weighted equivalent in SPY deltas. So in this case, the beta weighted equivalent in SPY deltas for selling this put is this is the equivalent of long 31 shares of SPY. So what that means is for somebody, if you want to know how this will affect your overall portfolio, we use kind of the most beta weighted info that we have, and then we compute the beta weighted deltas into SPY, so you know how it will impact your overall portfolio. In this case, it'll make you long 31 shares of SPY, and because that's what the beta weighting currently relates to. So not only do you know your probability of profit, your extrinsic premium, your chance of making 50% of max profit, your theoretical risk in shares, but you also know your SPY equivalent, which is super fascinating. Go back to BITO for a second. And the reason I keep putting this up here is because it's, we're in a situation now where an individual investor has choices. An individual investor is the smartest player in the field. And the reason they are is because they're small enough that they can do anything. They're not bound by huge dollars so that they're forced into certain products that can facilitate them. The individual investor can trade any product in any quantity. The commissions are virtually non-existent now, and you can do whatever it is that you want to do. And so again, being able to understand how much capital you want to commit to a certain underlying asset and what your probability of profit is going to be, just mathematically, pure quantitatively. There's nothing subjective about these numbers. It's a pure mathematical model, and it's a symmetrical model. Puts on one side, calls on the other side. You can do it both ways. Let's say you were bullish this. Instead of selling the put, you just wanted to, instead of selling the put, you wanted to buy the underlying stock, and then you wanted to go out to December, and you wanted to sell an out-of-the-money call. The expected move here in December is $9. You take $9, you add that to 39, it takes you up to 48. Let's say you want to sell the 48 calls, which is just outside the expected move. This is going to improve your probability of profit because it's going to lower your basis by $2.50, and it's going to give you a covered call, and it's going to actually make your cost basis, you reduce this number by $2.50 down to 37. Maybe that's attractive to you. That's a different way to play it. And yeah, will it limit your upside? Of course. But instead of making the $1.50 that you can make by selling the puts, in this case, you have a chance to make, $9. 48 plus 2.5, you have a chance to make, $10.50. So it's just a different set of metrics. So the individual investor can look at this stuff and go, hey, you know what? This is super cool. Now I can have a higher probability than 50-50 in a random marketplace, and yet I can reduce my basis. I could sell the put and have a much higher probability of profit, but I can't make as much because I have limited profitability. Or I can have unlimited profitability and look at that multiple ways by either using a future or the cash market. The cash market allows me to trade smaller. The futures market allows me to use less money. So now you got all these decisions to make, but they're all good, because challenging smart people to make smart decisions is one of the most incredible things we can do in the world of finance. All we can do is make finance flat, meaning we level the playing field so that everybody is essentially equal. When you eliminate commissions and you tighten markets and you play for liquid, efficient markets, there's almost no stopping the individual investor because they're not disadvantaged at all. When you look at these December markets here and you think about these markets are, this is the markets on the close, by the way, they're actually tighter during the day, but they're 10 or 15 cents wide. I mean, most of these trades will take place a nickel inside the offer and a nickel above the bid. Those are pretty tight marketplace and about on an 80% vol instrument. Anyway, let's take a look and see what time it is here. Okay, it's 11:34. So I just want to say a couple things. It was very nice having the ability to chat with you today. I am always available. I love working with Ken. I do these webinars every chance I get. I feel like it's an honor to still be able to do these after so many years and have so much fun with it. My email is tom@tastytrade.com. I do a live show on air every morning from 7 a.m. Central Time. We're in Chicago till 10 a.m. and we talk about this stuff every day, and from 2:30 to 3 in the afternoons as well on tastytrade.com, and it's completely free. And if you want to check out our brokerage, this piece of software that I'm showing today is the best piece. We built Thinkorswim and we built Tasty, and this Tastyworks platform is the best piece of technology we ever built. It's high frequency technology. It's incredible, and it supports every product where most brokerage firms don't. In fact, no other brokerage firms I know of do. And it's among the cheapest in the whole industry. And it is, like I said, it's high frequency middleware. So it's super fast and very stable. Any questions, you can just email me. I'm Tom@tastytrade. That's just tom@tastytrade.com, and I'll respond directly. It was great talking with you, and have a great webinar today. Thank you.
Hey, thanks. Hey, Tom, can I ask you one question? I like to ask you one smart question each year because I learn a lot from you. It's, how to say, I like to say, I used to be a statistician for Ford, and I'm a high frequency day trader. I like to say the math is a lot more important than the chart patterns. And what I love about your presentation is no magic chart patterns. You're a numbers guy, as any professional trader is. My thesis is that most trading educators don't even trade much, and all they have is magic entries. So they don't have exits, they don't have risk management, they don't talk about directional volatility. You trade small, trade often, which is brilliant. That's what I do. Can you talk just a little bit on I think you can do the trading industry a big favor if you can get them away from simplistically looking at cut pattern entries and more on the back end of things like volatility and doing multiple trades and re-entries and risk management and the whole thinking behind trade small, trade often, because that's how any good professional trades, including you and I really value your input on that, because you're the sharpest guy, you're the sharpest pencil in the bunch out there. So what's your take on it, Tom?
Well, I mean, Ken, you're preaching to the choir here. I've been talking about this now for 20 years. I mean, my background is I spent 20 years on the trading floor, and I never actually saw a chart. So traders just trade off, order flow and noise. And
right.
So I never knew that customers looked at charts until we built Thinkorswim, and then people were like, hey, where's your charting package? I'm like, what? I didn't even know anybody used charts.
Right.
So I grew up in this industry not even realizing. When I got introduced to the retail side of the business, it took a long time. And one of the reasons we built Tasty was, we don't want subjective stuff anymore. We want, I'll cover a couple different topics that you mentioned. First is the trade small, trade often, which is something we built around law of large numbers. If you believe that markets are efficient, which I do, I'm an efficient market theorist and or believer. If you believe that markets are random, which I do, to a certain extent, markets are emotional, but they're also random. Then when you think about that, then if you do things that have a high probabilistic outcome based purely on the math, then if you do it enough times and you stay small enough, the reason you stay small is because then you can never get hurt. You're always in play. The only way this business chews you up and spits you out is if you trade too big. If you keep your size in check, you're always back to play. Even if of course you're going to make bad trades. Of course you're going to lose money. But that means absolutely nothing. If you stay small, you're always going to, at the end of the year, come out wherever your probabilistic outcome was expected to be if you trade enough. That's the beauty of law of large numbers, and that's the beauty of trade small, trade often. That's for starters. And that's the argument, that's one of our arguments. The other side to it is people are smart, and people are tired of being told subjective things like, hey, this analyst knows more than you know. This professional has better information than you do. I don't believe in any of that stuff. Or this technician knows what's going to happen, or whatever, can give you a better probabilistic outcome. I don't believe in that stuff. I believe this is I've watched the greatest traders in the world and the best high frequency firms for my entire life. And they've built their models all around, it's all just about math. It's all about measuring implied volatility to give us an expected move and trading around that expected move. like I'll pick a stock, just a random stock, like just Netflix, because they had earnings last week. You take a stock like Netflix, and it's one thing when you say, hey, I'm bullish in Netflix or I'm bearish in Netflix. I don't care whatever anybody is, they are. It doesn't matter to me. But when you're setting up a position, it's really good to know that 70% of the time, this expected move, higher or lower, is going to be freaking spot on. And so if I'm doing the December position right now and I'm bearish in Netflix, I can go $30 above the market. I know, fact, 70% of the time that this $28 move higher is going to hold. So I can go $30 above the current price or go right to, let's say, 700, which is $35 above the current price. And I feel really confident that that 700 level is going to be good for me. So if I wanted to sell a call spread, sell a naked call is expensive, but I might want to, or sell a call spread in there, no problem. That's perfect for me. Knowing what the marketplace is telling you about expected move makes it just like betting on a football game. You know what the line is, and you think those lines are good. Well, wait till you see how good these efficient markets are, because they're 100 times the size of a sports betting market. So basically, what we've done is we've built a methodology and a foundation of trading around probabilistic math, quantitative math, and statistical outcomes, as opposed to anything that's subjective. And you can still be objective. You can still have ego. You can still have an opinion on what something's going, but you can just trade it, quantitatively with the most optimal approach, because that gives you the best chance of long-term success.
Yeah, that makes perfect sense. And thank you so much. So traders, I hope you read between the lines. It's a lot more about the math and the numbers than it is simply looking at chart patterns, because that's useful for range estimation and directional vol, but so much more successful trading is exactly what Tom Sosnov's talking about. So thanks so much, Tom. It's a real honor and a real pleasure to have you here. I genuinely appreciate it. You're one of the stars out there, and you've created a world-class platform. And I didn't know that you guys covered stocks. I thought you're options only. So you cover all asset classes. So a good all-in-one place for people to go. So highly recommend Tasty Trade and Tasty Works. And thanks, Tom Sosnov. It's been an honor.
Thanks, Ken. Thanks, everybody. Thank you so much. Bye.
Bye. All right, active traders, can you see my screen okay? Just wanted to double check everyone can see. Here's a quick authenticity check for everyone. If you could, yeah, an excellent presentation. I totally agree. Thanks, Renee. Hey, good morning, Nick. Hey, Kim, how you doing? Hey, traders, let's go ahead and take a quick look. One thing that I wanted to share with you, I made $1,600 yesterday, which wasn't a fortune, but keeps me out of a day job. Learn from people who really trade. I did just over 107 round trips yet. Well, I did exactly 107 round trips. Can everyone, okay, you can see. Thanks, appreciate it, Deb. It's my assertion that most of the educators out there are full of baloney and they're not even real traders. So make sure, first of all, you learn from people that actually do trade, number one, with brokerage proof like from yesterday. And the other is make sure that you're learning directional volatility and how to manage entries and exits. Now, I've got just about 15 minutes. Let me go ahead and get underway here with our presentation. One of the things that I want you to start looking for as an active trader is looking at range-based trading. Now, I don't know who else is trading DWAC. Anyone else? Our traders in my live room were enthusiastic. One of my really smart traders, Wendy, had mentioned it way back when it was like 15, and we called along at 16, and it did really good to 50. Look at all the halts. Now, one thing that you run into a lot of time with highly volatile instruments is halts. And let me put the old webcam on so you can see me here for a second. Hey, hello, active traders. Let me get some light on here. All right. So, hello, active traders. I'm Ken Calhoun from TradeMastery.com, and I'm a busy trader and I'm a real trader. So let's take a look at some of the patterns and strategies for active traders in today's markets. One of the things that really helps is to look for two-day high breakouts. One of the core rules that I made just over $600 on just 100 shares. Talking about trade small, trade off, and I bought I think it was just around 8 or so, and I sold the 14 right into the spike on the way up. One of the things you want to do as a trader, number one, is avoid trading anything that's on an inside range pattern, where it's inside the previous day's chart pattern. Always trade small gaps that continue. Like PHUN was a lot of fun for anyone who traded it. Ditto with things like DWAC, a really good volatility in HX to the downside, right? I did make some money trading the bounce here, but I lost a little bit trying to catch a secondary bounce. One of the things you want to look for is trade setups, and what I want to walk you through today, and I'm just going to cover one key idea because I made a lot of money with it yesterday. I like to trade UVXY. Does anyone else trade volatility ETNs? I used to trade VXX and then TVIX, and now UVXY has the best range. So I was knocking out of the park up to 1,100 shares on this thing into the big spike up yesterday. And I was telling my traders we're going long starting, it was 1625 in my live trading the open room. Here's how to day trade the right way. One of the things that I like to do is put up a C. First is use one triggers the other orders. Always use conditional orders. And the reason you want to do that is it automatically sets your trailing or your hard stops. Now, let me ask a quick audience involvement question. Do you folks generally prefer hard stops or trailing stops? I use both, depending on the chart, but do you prefer hard stops or trailing stops? Hit me up with what you're telling me. Tell me what you got. Now, I was trading thousands of shares of UVXY yesterday. I made just over $1,600, which isn't a fortune, but it's a nice start, right? The way that you day trade, the way that I day trade, is I put in a sequence of position sizing. Again, learn position sizing from Van Tharp. My colleague, I know Van, he's a good guy. Talking about the math and not just the chart patterns, the single biggest benefit to using charts is not support and resistance. It is range. Range is everything. So the range, look at yesterday, Thursday, this is a 2-day chart, Thursday and Friday. Thursday's range was 17.50 down to 16.3, so just about $1.25, and the same thing yesterday. So I knew the top would be up near 17.35, and I went to cash starting 17.25 after building up a significant position, anywhere just 200 or 300 shares at a time. So this is a really important lesson learned. To day trade correctly, you don't trade large trade. You don't do an ass backward. You don't do the opposite of what says. Do what Sosnov says. You trade small and you trade often, right? I did lots of trades yesterday. I think it was 107, something like that. What I'll do is I put in a sequence of trades, 200 or 300 or 400 shares, usually 200 or 300 shares every 20 cents or so apart, with either a 10 or 20 cent trailing or a hard stop, depending on the volume and the price action and time and sales. And one of the critical tools that's available to you that you need to use is the tape, right? I wrote the industry's first tape reading article called The Tale of the Tape for Active Trader magazine almost 20 years ago, and I did the world's first tape reading seminar at the Sheraton Anaheim in the year 2001. So I've been doing this a really long time, and I've traded millions and millions and millions and millions of dollars worth of stocks and ETFs. The right way to day trade is not trade a magic chart. Oh, a VWAP. Anybody use the VWAP? Stupid, don't do that. Anybody use MACD and stochastic and blah? That's stupid, don't do that. Day traders, it's all about momentum and directional volatility. What you want to do is set up a rack, kind of like rungs in a ladder. You put in your trades every 20, 30 cents. You put a tight stop on the back end to minimize your downside. Like Sosnov said, I like to always say that. Like Tom says, because he's right. Everything he says is right. It's straight on. Of the 4 things you can do, big wins, small wins, big stops, and small stops, the only one of those quadrants you're not allowed to do is big stops. And if you're using small share size with tight stops, that won't happen unless something gets halted and opens up significantly lower, which is one reason I'm not a big fan of the under $10 stocks. Trading stocks under $10 is not a smart idea in general, despite the leverage, because they often do pop and drop, or they get circuit breaker halted. Usually the first 2 halts are up, and then after the 3rd halt, it goes back down like PHUN. In general, charts like this are much better. I like charts usually $10 to $25, $30 a share, and that way I can put on a whole sequence of trades. So does anyone do that? You put in a layer, or how many of you do a sequence of trades. One of my smartest traders, Vic, is saying, what the heck is a VWAP? The value weighted average price, often used to, yeah, it's unimportant. As you know, all we care about is price action volatility. So, you know, when I'm putting on all these trades, and you can see, you know, a lot of these are all, you know, 200 or 300 share trades yesterday. And this is just a small fraction. I did 107 round trips. I didn't make a fortune. I work hard for the money, right? It's like that old song from years ago. I work really hard for the money, but I do well. And one of the reasons I do is I do a lot of small trades, 200 or 300 shares at a time. I think it's really stupid to trade thousands of shares of cheap stocks at a time. People who make YouTube videos claiming to make big fortunes doing that are about to be shut down by the Federal Trade Commission, thankfully. But until they do, just realize trading large is really unwise. Trading small, trading often, break up your trade. The reason is, for example, I would much rather take, you know, 10 $50 stops than one $500 stop. Be sure to look at the Tasty Trade, a really good video by one of his team, Mike, called Law of Large Numbers. And he has kind of a board with lots of numbers, lots of dots on it versus a few dots. And it's giving yourself many chances to get it right. Now, how many of you think that successful, this is what I'm going to say now is really important. How many of you believe that the win rate percentage is really important versus the net P&L? My biggest winning years, I've been wrong 64, 67% of the time. The win rate of how many of your trades percentage-wise work out is completely irrelevant. Nobody cares how, you don't have to be 51% correct in the number of trades you make, unless you're doing it really in a dumb way. The percentage of winning trades is irrelevant. Like that great word from the movie Princess Bride, inconceivable, right? If you want to make money as an active trader, it's all about the math and making the numbers work out. So I would much rather take 10 $50 stops, which I often do, rather than one $500 stop. My average stop loss cost is maybe $24, $26, because I'm using 10 or 20 cent stops on 200 or 300 share trades, up to 400 shares at a time. But I put on several thousand shares worth, but in increments and bite size, like Pac-Man, baka, 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 baka. You're looking at law of large numbers and trade small, trade often. So that's how I trade, and I live it. I don't just teach this stuff, I actually live it and trade it. This is a screen cap for my cell phone I was posting on a forum yesterday. So when it comes to making winning trades, the simple thought is break it into lots of little pieces, put in a sequence of, here's another quick takeaway, do a combination, a mix of both hard and trailing stops, because sometimes the problem with hard stops is up and down, right? Parabolic arc. If I buy 16.6 and it runs to 16.8 or 17 and comes back down to 16.6 and I have a hard stop right there, tough noogies, right? A better strategy is to use hard stops and manually tighten them as then something runs in your favor. That's how I make the most money. Is let's say I buy 16.6 and I put initial stop at 16.5, which would be very typical on 300 shares, and it runs up to 16.9. I'll manually reset that trailing stop, the hard stop, up to say 16.80 or 85. And inevitably, it'll probably pull back, take me out with a profit, a small incremental profit that feeds the kitty, and I'm on to the next trade. So use a blend, a mix of both hard and trailing stops. Now, my pet peeve with the entire industry, save for the people that I work with, but with the entire education industry is they're full of BS and they don't actually really trade. Ask to see tax return proof, like I show frequently of anybody who claims to be a trader. Ask to see their P&L, not just the P&L from the brokerage, but more importantly, their 4498 or whatever, 1099 or whatever you want to look at that's a tax return proof to validate that they are in fact a real trader. This industry is populated by charlatans, or like Obi-Wan Kenobi said to Luke Skywalker in episode 5 of New Hope about Mos Eisley Spaceport, you'll never see a more wretched hive of scum and villainy than trading educators, dum bum bum bum. Except for the people I work with. I carefully select the world's top, right? Like Macmillan and Nissen and Sosnov and people who I think can genuinely help you. So anyway, I'm going to wrap up here in just a minute, but does that make sense? A sequence of orders instead of big orders. One of the things we like to look for also is directional volatility. And here's a takeaway. I profitably traded, I think I got stopped out on GDX, but I made money on Dust. Here's a takeaway. You may have seen the article in one of my award-winning articles in Stocks and Commodities magazine. There exist things that have a 100, this is the statistician in me loves this. The only guarantee, the only 100% correlation that exists in the whole market is the inverse versus directional volatility in ETFs, like GDX, the long gold one, that's my favorite one I trade, or the inverse short gold one, which is DUST. So look at the 100% correlation. And I nailed this. It's an inverse head and shoulders pattern. Not that we care about chart patterns, but I knocked it out of the park, baby. Boom, flawless victory. And I sold up right near the 19. Sell right under whole numbers is another quick, or tighten up trailing stops right under whole numbers. That's another strategy. This is the only exploitable edge that we have in the industry, is the fact that, for example, GDX, exact 100% correlation, or 95% plus, whatever. I used to be a statistician, so R is probably greater than or equal to 0.95 in the GDX versus Dust pair, okay? You can trade one against the other. Similarly, the S&P, the Spiders ETF, is exact opposite of UVXY. So whenever the stock market drops, I'm in UVXY, and other inverses, like I like TZA too, the Russell Small Cap Bear is good too. Learning how to exploit those differences and how to trade them intelligently is the hallmark of a professional trader, not a, hey, it's a $3 stock, I'm buying thousands of shares, look at it run. That's for morons. Professional traders are all about the math and the numbers. You know, most of the trades I was doing, I did, how many trades did I do yesterday? I forget. The older we get, the more memory. I did, okay, 107 round trips yesterday. The vast majority of those winning, the ones that made me money, I wasn't looking at the chart at all. I was looking at the tape, and I was looking at my DOM, the order flow, my order book. I was looking at the entries and exits. I was looking at the numbers. I was strictly looking at the numbers that I trade. Remember what Tom Sosnoff said too. As a floor trader, they're like, what are charts? Learn that. It's really, really important. You have my word on it. Anybody who's an experienced, successful trader will tell you it's the math, guys. It's not the chart patterns. Trade like an accountant, not like a cowboy, all right? So I think my time's about up. I'm going to make like a banana and split. Let's see what else. I think we're about done here. I'm done. We've got Larry McMillan, Steve Nissen, and Jeff Gibby coming up next, but y'all have been great. Thank you so much for being here. And I've got 2 minutes left, and I will turn it over to Larry. For more, be sure to visit my site at trademastery.com. I've got a free Saturday. I've been doing these for over a decade. Over 4,000 people have registered for them over that time. So hugely popular, and they're free. So you can join me, get to know me every Saturday. Be sure to get to know Sosnoff too. Watch his First Call Sunday afternoon episodes on YouTube. They're fan. I only watch him and Tony. I just watch the first 10 or 15 minutes. Sosnoff talks about crypto and the SPOOs and whatever the futures are, other futures are doing pre-market. So watch the first 15 minutes of Tom Sosnoff every Sunday on YouTube around 5 o'clock or so. He posts a replay. So Sunday afternoon on YouTube, find Sosnoff talking. He's brilliant. I've watched many, many, many dozens of his shows. He's one of the smart guys. And follow me on Saturday mornings on my Trading Week Ahead events. And you can join me every Saturday at 10 o'clock. And I answer questions. We go over both swing and day trading. Now, I'm not an options trader. I'm not a futures trader. I'm not a Bitcoin trader. I'm not a currency trader. I'm a stock and ETF. I'm a hardcore stock and ETF, mostly day trader. So that's what I do. I do the voodoo that I do so well. The other thing that I paid close attention to, and I'm going to turn over to Larry here momentarily, is the VIX. Larry's brilliant on the VIX. He knows more about the VIX than anyone I know. So Larry McMillan coming right up, but keep a close eye on the VIX, the SPOOs, trading ranges, directional volatility, and avoid charts that are inside the previous day's range. Never ever trade anything that's inside the previous day's range unless you got a really good reason. So trade minor gap, small gaps that continue up, or 2-day high breakouts. And I think that'll wrap me up. So let me turn it over to the illustrious Larry McMillan, one of the foremost options experts in the world. And I will.
Hi, Ken.
Hey, Larry, how you doing? You are live, sir.
I'm doing good. So how do I get my screen on here? Let's see.
let me turn it over to you. I've got to.
Oh, okay.
I've got to click make presenter here. And we should be good to go. Let me click the yes here and.
Okay. Looks
And there we
like
go.
this.
So, folks, let me just quick introduce. For those of you who've been living under a rock and don't know Larry McMillan, he's the author of the best-known Options as a Strategic Investment that sold over 300,000 copies. Must be good. He's an active trader. He's one of the smartest guys out there. As usual, the people I feature here are nothing but the best. And Larry McMillan, one of the world's top, if not the top options expert, and really knowledgeable on the VIX. I learned a lot from Larry on the VIX too. So, Larry McMillan, thanks so much for being here, and take it away.
Oh, thank you, Ken. All right, so we're going to spend a half an hour or so talking about the market and options and what our option indicators are saying. It's a pretty interesting time right now. I started this company originally as a derivatives research company. We were publishing newsletters, selling data, that sort of thing. But after 2008, when we were pretty successful with some of our recommendations, some of our clients wanted us to manage money. So we are a CTA and an RIA firm managing individual option accounts. So like Ken said, you want to be sure that people actually trade. Well, you can't be those things if you're not trading it, or I suppose you could, but you wouldn't have any AUM to report. And then we also do a certain amount of education, mentoring and seminars like this, etc. I'll come back to this later, but we have set up a page on our website, optionstrategist.com/trading summit, and we're offering discounts on some of our top newsletters. We also will send you a PDF of this webinar. So there's four main things I look at. Number one, the chart of the S&P 500. If your indicators are telling you one thing, but the market's doing the other, of course, the market is right. So you might want to adjust your indicators. Secondly, we'll look at equity-only put-call ratios and then on the individual stocks as well. Then we'll discuss market breadth, where we have an option-oriented twist there. And then the volatility, not only the index VIX, but the various derivatives that you can trade, VIX futures and options. So I have a couple of important rules that really dominate my thinking on certain things. And the number one is oversold does not mean buy. So the market can become oversold and stay there for a long time, or at least for a long distance. March of 2020 was a classic example of that. We were probably oversold right by the end of February because the market went down sharply for a week there. But it continued on down, and you would have been overrun if you had bought on March 1st. So we wait for confirmed buy signals. We're not trying to catch the falling knife and just say, oh, it's oversold, let's buy it. Also, conversely, overbought does not mean sell necessarily either. Since March 2020, the market's gone up a lot, and several times it's reached overbought status. But until you have actually confirmed sell signals, we don't act on those either. So here's the current chart of SPX, and there's two things that stand out here. Well, first of all, we were in a downtrend coming off the, oops, sorry, I don't know what I hit there. We were in a downtrend coming off the highs of September 2nd, and you know that downtrend lasted for most of the month of September. It's this red line here, but we broke through that decisively about a week ago and roared to the upside. And so now we've reached the all-time highs at 45.50 roughly, and we stalled. The last couple of days have not been particularly good in terms of either breadth or some other things we look at. On the other hand, if we break on through here, there's certainly going to be a vast number of people going to have to get on board from cash on the sidelines or cover shorts. On the downside, we roughly have support in this general 4,300 area here. You can see we probed below it a few days in early October, but that's generally support. So the question is, are we in a trading range here? Are we going to go back to those lows, or are we ready to break out to new highs? All the little circles on the graph here are gaps. And you might not think that a big high cap index like the S&P would gap, but it does. And most of the gaps get filled. So all the green circles are gaps that got filled. And you can see in the last couple of months, we've been filling in almost every gap routinely. Now, if we go back here, though, to May, and even this big one back here in the end of March, first day of April, those gaps have not been filled. So not every gap is filled. But look what's happened in the last week. We have 4 gaps. This is a daily chart, of course, and so we have 4 gaps here. So if gaps are to be filled, that would argue for the trading range environment. So we've set up actually a trade to sort of take advantage of this, looking for these gaps to be filled. But I'm not saying that I'm necessarily bearish. I'm just bearish to that extent that these gaps could be filled. So just to summarize this, we're looking at this as a question between, is it a breakout to new highs or a trading range? If you short the market here looking for those gaps to be filled and you want to stop yourself out, you would stop yourself out, say on a 2-day close at new all-time highs, and that's a pretty tight stop. So I don't think you'd lose a lot of money that way. To me, though, these gaps do suggest a trading range. So we'll see. We'll see. But our newsletters, at least some of them, have taken positions in this line. Now, there's another thing we do on the S&P chart is that we draw Bollinger Bands, but we use what we call modified Bollinger Bands, because when John Bollinger invented Bollinger Bands, he used as the definition of realized volatility, he used the standard deviation of closing prices of whatever you're drawing the Bollinger Bands on, let's say SPX. But in the math world, where Black-Scholes reigns or other option-oriented things like that, they use a slightly different definition, and that's the standard deviation of daily percentage price changes. That's a different number, but since we're an option firm and we need our stuff to agree with Black-Scholes, otherwise our implied and historic volatilities couldn't line up with each other, it wouldn't make any sense. We stay with their definition. So we draw Bollinger Bands on the S&P chart using that definition for realized volatility. And we draw the 3 and 4 standard deviation bands, and we get a signal when the market moves outside the 4 standard deviation band, either plus or minus, and then back inside the 3 standard deviation band. So over the history of this trading signal, it's done very well for us, both theoretically and practically. We have a long track record over the Option Strategist newsletter recommendations posted on our website. This is one of the better strategies we've had over the years. But we did notice that it was getting a number of false signals, so we put an additional criteria on there for follow through. We call that the MVB or McMillan volatility band, but it's basically the same thing. So here's the current chart of that. And you can see, for example, let's just say back here in January, we moved outside the 4 standard deviation band. That's what that one is. Sorry. And then back inside the 3 standard deviation band, which is that. And these are, of course, the positive ones. The negative ones are down here. And that was a sell signal. Well, our sell signals are, or any signals, completed by reaching the opposite band. So here we were waiting for this to reach the opposite side, which it finally did over here, the -4 standard deviation band. You can see that that really wasn't a great signal. In theory, it did reach the -4 standard deviation band, but it didn't make any money. So that was not a great signal. But we followed that quickly with a buy signal. So this is the first buy signal we've had here. We moved below the 4 standard deviation band. They're right back inside the 3 here. So we're long from that level, and we're long options. So we have time decay while this is going on. But it is the first buy signal we've had from this system since the great one at the end of March of 2020. So this is long, and we're looking for it to reach the the +4 standard deviation band, which is right here now, about 45.75. That would end this buy signal. So that signal is still in place. If you think this looks like an interesting concept, we do offer a service where we will send you these McMillan volatility band signals daily on every stock, ETF, futures, index, whatever, We keep them all in our system. You receive an email with that. Anyways, the next thing we look at is put call ratios, and put call ratios were invented as a contrary indicator by Marty Zweig back in the 1950s to actually use put call ratios to predict a broad market. We use what we call equity only put call ratios. It's not just we, I mean everybody calls them that, and that means all stock options that trade, not index, not futures, just stocks. So the theory is if there's too much put buying going on, then you should be looking to do something bullish, or if there's too much call buying going on, you should be looking to do something bearish. So we've quantified that in this manner. Typically, let's say the stock price is here on the top and the put call ratio is on the bottom. By the way, if you're looking at a put call ratio chart, you would also normally want to look at the stock price. We post about 1,600 of these on our website every day in an area called the strategy zone. But let's say, well, the stock is declining here. People are buying puts, forcing the put call ratio higher. And that's typical. During a trend, the public makes money. But eventually, the put call ratio will top out, will form a local maximum. And a local maximum in the put call ratio is a buy signal for the underlying stock. So in theory, then it would start going up. And as the stock is going up, I must move over to the left, continue this. Stock is going up, people are buying calls. That forces the put call ratio down to eventually it reaches a local minimum. And a local minimum is a sell signal for the underlying. So this is not a current chart, but on top is the S&P 500, and on the bottom is the equity only put call ratio. And you can see the inverse symmetry that exists most of the time. So that's why we use the equity only put call ratio as a predictor of the S&P. Here's the current chart just using the volume of options, which we call the standard ratio. And you can see it's been busy this year, a lot of back and forth, but most recently, we have a local maximum over here on the right side of the chart. This is right here. And there's a little question mark here because we have some computer analysis programs that look at these charts, treating them sort of like a chess tree, can look forward a few days. And this computer is still worried that this might revert back up. Personally, I don't think that would happen. So we have this buy signal here in place anyways. You can see we had a decently timed sell signal. Might be a little late on that. But back and forth over the year, it's flipped back and forth a few times. And in fact, here last February, we got the lowest that we had been in 21 years, almost 21 years. And it was really, that's an extreme amount of optimism to force the put call ratio down to that level. It didn't really result in a huge decline in the market, but still, it's reflective of how many buyers of calls there were at that time. We've come the opposite way now. There were a lot of buyers of puts during October that forced the ratio up to here. We also look at what's called the weighted put call ratio, where we measure the dollars being spent on calls versus the dollars being spent on puts. And this gave us a much higher ratio. You can see that that's the highest we've been. Really, it's actually the highest we've been since April of 2020. So that's a really solid buy signal there. Extreme pessimism in the market, especially in terms of dollars being spent. Everybody was loading up on puts, and now the ratio has turned. Gave us a buy signal right near the bottom there. And so this also is still on a buy signal, it's bullish. So just to summarize, this historically also has been a very good trading system. It's not necessarily a system, but we buy on those signals, and then we run trailing stops, or however you want to manage your position from there. So this current one is emanating from a very high position on the chart, which means was a very deeply oversold market. And of course, as we say, we don't buy it just because it's oversold, but now that it rolled over and starting to trend down, that is a confirmed buy signal from the equity only put call ratio. What do we actually buy when we buy these things? So in those two cases, the Bollinger Band modified, or McMillan volatility band, and also put call ratios, we're buying S&P or SPY option. So we're buying SPY, and we typically try to buy an option with a fairly high delta, because if I'm right on the underlying, I want to be right on the option too. So delta of 70 or higher. Maybe if you're going out longer term, that would be a short term. I know everyone's definition of short term is different. Ken does a lot of day trading. I mean, short term for him might be a trip up to the kitchen to grab a soda and back down again. Or long term, I'm sorry. Whereas for me, yeah, right. So for me, it'd be more like 3 months or something. Anyways, you see on TV, all these traders seem to, are not traders, they're just TV personalities, say they're spread all the options. So why would you spread? When you spread an option, which means you buy a call at this lower strike and you sell a call at a higher strike, when you do that, you cut off your profit potential. And to me, that's a big waste. I totally agree with Ken when he said, look, it doesn't make any difference what your percentage of winning trades is. You want to have a few big winners will make you success. But you can't have big winners if you're cutting off your profit potential. So that's one reason I hate to do this. But the other reason is that it just doesn't make any sense. And sometimes people will say, oh, well, you know, you're risking less money. Well, not really. You're risking 100%, whether you buy that call bull spread or you buy the call. So if you're wrong, you lose all your money on that trade. So, you know, unless you get out of it later. But I'm just saying that you can arrange that so the amount of money you spend is equal. You buy a few less outright long calls than you would have bought spreads. But now if the stock goes way up, you make money. In any case, there are times when you might want to spread, and that's when the options are expensive. So right now, S&P VIX has been high, like for really a year and a half. So during that time, it probably made sense to be doing bull and bear spreads on SPY rather than just outright positions. But you can also mitigate the profit potential that gets cut off by widening the distance between the strikes in your spread. So right now for SPY puts, I think we're using 20 points right now, and for SPY calls, 11 points on a spread. And then if you're on a bull or bear, vertical spread, if the underlying goes through your short strike, well then you can roll the whole spread. You're making a profit at that point in time, but you're about to have it cut off. You can't really grow much from there. So sell the spread you've been in and buy a new one, and you can continue to do that along the way as well. Just want to show you a couple of individual put call ratio charts. This first one is ARK. Everybody knows ARK, of course, and it's given some really good buy signals this year. Now, we only take buy signals when they're at a peak of the past 600 days. So that one was at the time. It dwarfed later by, say, this one. And now the new one we just had, this one. So you can see that, this one back here was a very good local maximum. It's a buy signal, very good buy signal. This one was pretty good. And now we've got a new one just in place. Also, Corning Glass reached an extremely high level on its put call ratio chart, really the highest it's been since March of 2020, and that's a new buy signal there. And if you're interested in charting sort of things, which we don't really do trend lines too much, it did break through a trend line there too. And then finally, silver. Now this is the silver ETF, but the put call ratio using silver options that trade on the COMEX, or what used to be the COMEX, also are giving a buy signal there to local maximum. So that's those are all three new signals that we just put out recently. Yeah, if you're trading, you may not have a futures account, so you say, well, I can't do the futures, but this put call ratio right here is sugar, based on sugar options that trade, in the on the commodity exchange. But you can trade usually an ETF instead of that it will do the same thing. So the put call ratio there is not SGG options, which is the sugar ETF, but in fact is based on the actual futures options. But you can trade, obviously, the sugar ETF and sugar itself should move in tandem. So next thing we look at is market breadth. We can do a couple of things with it. Keep an oscillator, track advances minus declines. Our oscillator, going back over the years, has the green areas are oversold. We haven't been oversold too many times since the market's been really bullish since a number of years. Did have a couple of major oversolds, but now we've moved into overbought territory. So we got a buy signal right in here on September 22nd from this oscillator was coming out of oversold territory. And now we've gone into overbought territory, but that can be a good thing. As long as we stay in overbought territory, the market can continue to go up. If we fall out of overbought territory, that would be a problem. So as I said, we've had this buy signal since the 22nd. What I'm a little concerned with is now that we've reached these new highs in S&P the last 2 days, Thursday and Friday, meaning yesterday and the day before, breadth has been weak. Is either negative or barely positive in both New York Stock Exchange data and what we call stocks only data, which is all optional stocks. So we're watching that pretty closely, but this is a short-term indicator. It can have whipsaws, but it usually does pretty well for us. And so it's still on the buy signal for now, but the failure to confirm breadth last couple of days is, I think, somewhat concerning. Cumulative breadth is we do with volume, and so we do the same thing, add up breadth advances minus declines, but we do advancing volume minus declining volume, and it made recently new all-time highs on 5 consecutive trading days. On October 14th, of course, SPX was not at a new high. That was just beginning that run that we've seen recently. So the fact that the CVB made a new high was predictive of SPX making a new high, and now it has. But it has no further predictive value. So you'll hear people say, oh, the advanced decline line has made a new all-time high at the same time as the S&P, so that means everything's great. It doesn't mean anything. It means that, okay, you lined it up, it was fine. It has no predictive value going forward. When the cumulative thing makes a new high before S&P, yes, that has predictive value, but right now it doesn't. And I can prove that to you very easily. Just go back and look at where things were on September 2nd. All the cumulative things were making new all-time highs. SPX is making a new all-time high, and SPX went down for 5 weeks. So that's not predictive. Meanwhile, if we just look at not volume, but it's just the cumulative total of advances minus declines, this advanced decline line has not made a new high since June 11th. So that's a big negative divergence. Those can stay in place for a long time, but those are a huge warning to not be complacent. So finally, let's end up by talking about VIX a little bit. So there's 2 things about VIX that are very important. Number one, the trend of VIX. It should be trending opposite to the market, or maybe the market should be trending opposite to VIX, I don't know. And then spike peaks are buy signals. So we haven't had a low VIX in a long time, really, I would say, since the beginning of 2020. But when VIX gets low, it's overbought, and the market is overbought. But that doesn't mean you should sell. Again, overbought does not mean sell. You would have to wait for VIX to rise. In any case, that's not relevant right now. Here's the current VIX chart, and those are the spike peaks on there marked with those Bs, all for buy signals. Reds are successful trades, blue is not. We're currently operating one that came on October 1st. That's been pretty successful. Well, actually, quite successful. So what we do in these situations is we roll our options up when they reach, a higher strike. So in particular, this one we bought as SPY calls. When SPY went up like 10 points, we rolled to a higher strike. So lock in a nice credit there, and more than we paid for the original option. So you can see now, though, that right now VIX is at the lowest it's been in a year, down around 15. And it's been, I think, somewhat surprising that S&P makes all these new all-time highs for well over a year now, and VIX is still trading at 15 or higher. Some people think that shows a lot of worry by big, knowledgeable traders. VIX is based on what's happening in SPX options, the implied volatility of SPX options. The SPX options are traded by big money, and I don't know if that necessarily means it's smart money, but it's big money. And so they've been worried somewhat and kept VIX fairly high by buying out of the money puts and paying a lot for them. But now that's starting to come out of the market. So anyway, we're operating on that spike peak buy signal. These two little circles here are interesting. So if you'll notice here, so this more wiggly line is the 20-day moving average, and the flatter line is the 200-day moving average. Right here in this circle, the 20-day crossed above the 200-day, and VIX was above as well. That is a sell signal from a market. Now, it didn't pan out. In fact, it's been reversed by over here. Now you see the 20-day went back below, and VIX is below. But we always pay attention to this because there have been some of the biggest declines in the past have been signaled by that. And for example, that happened on February 20th of 2020, and on February 24th, the crash started, the pandemic crash started. So yeah, we were in that signal lost, but it was a fairly quick stop out, and so we certainly would always pay attention to that. So right now the trend of VIX is lower though, because the 20-day is below the 200-day, and VIX itself is trending lower. So this just sort of repeats those things. There we did have a series of those buy signals all year because we kept getting a sharp monthly sell-off about once a month, and it would make VIX spike up and then give us a buy signal. So we sort of been on those buy signals for a while now. As I said, the trend is bullish because the VIX and the 20-day both dropped below the 200-day, and then they're below it now. They had crossed above, but they're below it now, so that's bullish. Anyway, there's another thing to look at, and that's the volatility derivative products that actually trade. So it's bullish for stocks when VIX futures are at a premium and the near-term structure slopes upward. So right now, VIX is about 15, and the first month, which is now November, is about 17, and then the second month, December, is about 19, et cetera, et cetera. So the term structure slopes upwards, and they're all above VIX, and that's bullish. And that's the way things look most of the time. Occasionally, it flips over and goes the other way, like in March of 2020, and it's bearish when that happens. So I'll show you in a second when we decide when that's happening. But here's the current picture. VIX closed yesterday at 1543, and the November futures closed at a whopping $3.70 higher. Now, these November futures are based on SPX options expiring the next month, but they themselves, the November futures are going to expire on November 17th. So this differential, this 377 differential, is going to disappear by then. So a trade can set up, but you can see then if the term structure definitely slopes upwards. Each one's going higher and higher till like next May is trading at 10 points higher than VIX. And so we have I'll show you in a second, a trading system to try to take advantage of that. If you don't have the VIX futures prices, you can get them off the CBOE website delayed if you just want to check the prices. But CBOE does publish indices all day long, every day. That is a 9-day volatility index. VIX is a 30-day, a 3-month, a 6-month, and a 1-year. And again, you can see the term structure of these slopes steeply upwards too. So that's bullish as long as that is in place. So what we do though to notice if the trend is going to change, we watch the front month versus the second month. So right now the second month is trading 2 points higher than the front month. That's fine. But if November so suddenly jump up and go higher than December, that's an immediate sell signal, would require immediate attention. And some of the biggest, sharpest declines of the last few years have been signaled exactly by that inversion of the front month there. So I said there's an advantage, a strategy to take advantage of this, and that is to buy puts on both SPY and VXX. And currently, with the ratios of volatility and everything, you buy 5 VXX to 1 puts to 1 SPY put, and all the puts have the same delta. So we have put that position on as well. So just to summarize, the SPX chart would be bullish if we break out to new highs, meaning like meanwhile, we have that volatility band buy signal, put call ratios on buys, breadth oscillators on buys but weakening. VIX spike peak is on a buy and its trend is bullish, and the term structure is bullish. So mostly everything there is looking bullish, and if we break out above 45.60, that would certainly confirm it. But we will trade these individual signals as they occur. So if we do get a breadth of sell signal, and we do start going down and filling those gaps, we would trade on that as well. I was going to just mention this. So we have an October seasonal buy signal, which is you buy the end of the month. It has a great track record, but we only trade it if the market has gone down 3.2% at some point during the month of October. That has not happened. It could still happen, but it would be a pretty big drop from here to go down 3.2% by next, was it Thursday? So I don't think that's going to happen. So just to summarize, if you would like a further look at our newsletters, we have a discount at that URL. We will send you a PDF of this webinar. We have some other products. I also have a YouTube channel. We record a market comment on Mondays. I have to get Ken to subscribe to that one.
Yeah, right.
And then we have those other products as well, including a new home study course. So that's our contact information, and I'll return it to you, Ken.
Hey, thanks so much, Larry. Really good coverage. And I completely agree. I'm following VIX at the 22 to see if it recovers. A good tip on the 2200 crossover. That's one thing I hadn't picked up. So thanks so much, Larry McMillan, one of the world's top experts out there, and highly recommend him at www.optionsstrategist.com. And thanks so much, Larry, for being here. Appreciate it.
Thanks for having me, Ken.
All right, next up, we've got Steve Nissen from candlecharts.com. Hey, Steve, how you doing?
Good, doing fine, thank you.
Let me turn control over to you here.
Okay.
And in 3, 2, 1, and I will introduce you in just a second here. All right, so traders, Steve Nissen is the world's foremost candlestick chart expert. I worked with Steve for over 20 years, and I make a lot of good trades. I make so many of my successful trades that I'm profoundly grateful to Steve Nissen, because not only do I work with him, but I actually use what he teaches, and it works, so that's good. I use hammers and shooting stars and bullish and bearish engulfings. Unlike other candlestick educators, Steve Nissen is the world's foremost expert. He literally had transcribed and wrote the books. His work has been followed by virtually everyone in the world that trades. And so Steve Nissen from www.candlecharts.com. Welcome back, and it's great to see you, my friend. Good to have you here.
Thank you, Ken. Great working with you again. We've been working together for many, many years. So what we're going to be doing today is going over what I call the 3 secrets of successful trading using candle charts. And the reason I wanted to do this is because while many of you may be familiar with the basics of candles, it's not just understanding the candles that are important, but there are other aspects involved in trading when you do use the candlestick charts. So before we begin, let me give you our risk disclosure and just remind you, obviously I'm not going to read this whole thing, but just remind you that there's a risk of loss pretty much in any market that you trade. If you do want to see the whole disclosure, go to the link at the bottom of this page. Now, for those new to candles or kind of need a refresh, let me give you very briefly the major benefits of candlesticks. They're very easy to understand. For those new to candles, I'll just go over, within a half a minute or so, the construction of the candlestick line. The power, the potency of candlesticks is they give you early reversals well ahead of traditional Western technical tools. I'll show some examples of that a little bit later on. Safety first trading, okay, knowing what not to do. A trade or investment might look good on the outside, but by correctly understanding how to use candles, you could avoid potentially bad trades. East and west. In other words, East is Japanese candlestick charts, and West is Western technicals. And Western technicals are really important. I'll go through that as one of our secrets in a couple of minutes. And I'm sure you may be aware of this, but if not, candlesticks work in all markets and all time frames. My books have been translated into actually over 20 languages. Interestingly, even Japanese, where this actually began. And we have students at candlecharts.com from over 85 countries. So just show the universality of how candles can be used in any market that you may trade or potentially trade or invest. So just a very brief review. I do this in all our seminars, just to make sure we at least start with the basics. A candlestick line is made of two components. The rectangular portion is called the real body. The lines above and below the real body are called the shadows. Some traders will call them whiskers. But essentially, if it's a green or empty real body, that means the close is higher than the open. And a red or black real body means the close is under the open. And when the opening and closing are the same as they are here, these are called doji. And the power of the candlestick line, although it uses the same data as a bar chart, open, high, low, and close, because of the way it's drawn, the candles, like a bar chart, will show us the price. But the reason the Japanese shifted over to candlestick charts back in the early 1900s was because candlesticks reveal the force of the move. And just for an example, okay, here's a green real body. We know because it's a green real body, the close is up here, the open's here. What does this mean? Who's in control? Obviously, the bulls. Here, there's a red real body, the close is down here, the bears are in control. And this could be a 5-minute chart, a 1-minute chart, a weekly chart, a monthly chart, it doesn't matter. Here on the right, a doji, who's in control. Now, remember, dojis when the opening and closing are the same, and that means the market's in balance between the bulls and the bears. And just as a heads up, this is a doji, but just as a heads up, as I started to say, you know, many of us know that a doji is a potential top reversal signal, but a lot of traders and investors really misuse the doji. I'm not going to get into it here. There's other education I'll mention at the end of the session, but a doji during an uptrend doesn't change the market trend from up to down. It changes it to neutral, because a doji doesn't mean the bears are in control. It means that the market, let's say it's rallying with a series of green candles, and you have a doji, that means the trend has gone from up to neutral. And yes, while that increases the likelihood of the market reversing, it's not a bearish reversal as would be, say, a shooting star or a bearish engulfing pattern. So let's kind of segue now into the first of our 3 secrets of how to correctly use candlestick charts. And before we do that, we're going to be asking 2 questions to ourselves. Is the market at support or resistance? And however you define support or resistance, continue doing that. I just like looking at major lows and highs. You may be looking at moving averages or trend lines. But the first thing you should be looking at is the market you're trading or thinking about trading or investing in. Is that support or resistance? And then the second part, the second question is the candle signal currently where the market is at support or resistance show that the trend is weakening? Because remember, the candles, when a candle signal does emerge, is usually an early indication of a market turning. So by looking at these 2 questions, we're going to combine them and getting to our first secret. Is the candle signal hinting of a weakening trend? So getting back to the prior slide, if the market is at support or resistance, okay, and we have a candle signal confirming that Western signal, that's why it's so important to add Western technicals, it's a more likelihood of the market reversing. And that is something I will always do when I'm setting up a trade or an investment. I will always see if the candle signal is confirming support or resistance. Usually, it's pretty rare where I'll set up a trade or investment based purely on a candle signal, because remember, we're trying to pick tops and bottoms of moves. And what that means is it's a very high risk trade. So to get the odds on our side, I'd like to see the market at a support or resistance area. Okay, so secret 1 is a candle signal hinting of a weakening trend at support or resistance. And we're going to look at some specific examples of this in a minute. But before I do that, kind of want to refresh your memory. A bullish engulfing pattern is when the market rallies, sells off, and then we have a green candle wrapping around a red real body. It's a bottom reversal signal, and a hammer. The market's in a downtrend. We have a very long lower shadow, twice the height of the real body. and it could be a red or green real body. These are bottom reversals. So let's look at this. So here in Bitcoin, and what I tried to do is give different markets and different time frames. So here in Bitcoin, classic bullish engulfing pattern. See the green candle wrapping around the red real body, and another bullish engulfing pattern with the green candle wrapping around a red real body. So this is a bottom reversal signal based on candles. Okay. Same thing here in Amazon, the major low is a classic hammer. Look at the length of that lower shadow. Remember what the lower shadow is telling us, that sometime during the session, this happens to be a daily chart, the market got down to here, and by the end of the session had rallied to close at or near the high of the session. And while this was a red real body, it doesn't really matter because the market closed right near the highs. So the hammer is a good bottom reversal signal. If you do trade based on the hammer or the bullish engulfing pattern, I always suggest using a protective stop under the low of the hammer or the lowest point of the bullish engulfing pattern. So here's the bullish engulfing pattern from the prior slide. I'd keep a protective stop here or under here. And another hammer here on Amazon. This is going back just a recent hammer back in August. And many times the hammer or the engulfing patterns will become support or resistance. So you can see down here, the hammer held as support. We didn't go over this particular candlestick signal here, but it's called the bullheartomy. It's a small real body in an unusually long red real body, not normally a major reversal, but it is a bottom reversal candlestick signal. So we're going to look at these three markets in a couple of minutes. But before that, what I want to do is segue into the importance of looking at Western technicals. Okay. So the first one, remember, we're looking at is the candle signal hinting of a weakening trend. Okay, so here the bullish engulfing pattern, weakening trend, a hammer, the weakening downtrend, and same thing here, downtrend and the hammer. Now we're going to look at the second secret. Always add Western technicals. So the first one is look at the candle signal to see if the prior trend is running out of steam, as we did in the prior examples, and always add Western technicals. I mentioned this before because we want to increase the likelihood of us calling a top or bottom. And here is my desk where I did all my research. So these are just some of the Japanese books that I paid somebody mucho bucks to translate. This binder here is all the English translations of the books here. And what I did is I broke it up in different sections, doji, engulfing patterns, and so forth. And each one of these pages actually cost me about $20, $25 to translate. And that was going back years ago. But anyway, it was worth it because when I was doing the research, I was giving trade recommendations. I was working at Merrill Lynch and E.F. Hutton for you old timers out there. But while I was at Merrill and I'd give trade recommendations, and I was doing the research in the candles before I wrote my first book. And I didn't let the brokers know I was using candles for my trade recommendations. And I actually had the best track record in the department. And then that really gave me an incentive to continue spending the money to learn what I call the secrets of the Orient. But the reason I wanted to show you this is because in just about every one of these books, although they focus on candlesticks, they all had Western technicals in them. And that's what the Japanese have been doing for generations, combining Western technicals with candlesticks. So for example, here we have two doji. I call this candles in context. Here's a doji and here's a doji. But here's, for example, the RSI. On this doji, the market is overbought. On this first one, it's not. So the likelihood of the market reversing is higher with this particular doji. So this is an example of adding candles to Western technicals. But how I do it is, as I mentioned before, I will look at support or resistance with the candle signal. So yes, I may see a doji here or here, but I'll go back as far as necessary to see if the doji, which is a potential top reversal signal, is confirming a resistance area. A little bit of a nuance here, a little bit more advanced. I didn't mean to get into it, but I may as well explain it now. Here we have a doji, and even if it was confirming resistance, I would still wait for a lower move the next session, because although it's a doji, isn't it still making a higher high, a higher low, and a higher close? Yes. So I would wait at least to get some extra confirmation that the market indeed is weakening. Now, we all have our own trading strategies, and you may not want to wait for bearish confirmation of that doji. The plus of waiting for bearish confirmation, i.e. a lower move under the doji, is, let's say, you're shorting, Larry was on a couple of minutes ago, so let's say you're doing an option trade, a bear option trade, and you're shorting, well, let's say it's a Forex, which it's not. It's very easy to short in Forex. But if you wait for bearish confirmation, you're getting a lower price. So your profit potential is less, but you've increased the likelihood of the trade working out. Now, one of the reasons I also focus on bearish signals, although most of us don't short in equities, is it's a great time to think about lightening up if you have any long positions, or move up protective stops. So think of bearish candle signals not only as potentially a time to short, but as a time to lock in some profits or move up protective stops. But let me show you how I use candles with Western technicals. Okay, so here we have this classic bullish engulfing pattern, correct? With Bitcoin and over here. But the reason this took on more likelihood of the market reversing, is it confirming anything? Right, support. So this happens to be a hammer also. And very often, and we saw it before, and I'll show it again on one of the other slides, the hammer becomes a support area. But even if that was not a bullish candlestick signal, even if, say, it was a long red real body, okay, but this was a low from where the market rallied, I would still use that as a support area. And then we got the bullish engulfing pattern here, confirming support. So if you did a trade, you'd keep a protective stop under the low here, below the hammer over here. Same thing here. What is particularly potent about this bullish candlestick signal? It's confirming a multi-tested support level. Okay, this happens to be, for those a little familiar with candles, this actually is called a piercing pattern, where the green candle gets deeply into the red candle but doesn't wrap around it, where this is a bullish engulfing pattern. Some of you may also recognize this as a morning star. But this is what I really look for. One, a candlestick signal hinting that the prior trend is running out of steam, as it is here. And then if it's confirming support or resistance, classic case. Same thing here. Okay, we saw the major low in 2021 at Amazon with that beautiful hammer. And the reason that took on extra significance, look what it's confirming. A support level going back to September of 2020. So we had a classic hammer confirming support. And this is what I look for. If there's a resistance area, I would do the same thing. I'll show an example in a couple of minutes. Okay. We saw this hammer before. Look what it confirmed. Okay. A doji. Dojis, by the way, usually work better at calling top reversals than bottom reversals. Just to give you a heads up on that. Let me give you a little trick question here. Here's a green candle wrapping around a red real body. Okay, is that a bullish engulfing pattern? No. Why? Because the trend is wrong. A bullish engulfing pattern has to come after a downtrend. And we could see how important it is to understand candles in context, not only if you can correctly recognize a green wrapping around a red as a bullish candlestick line, but you need to remember that they have to come after a downtrend. See a little downtrend here and a downtrend here. So getting back to this, is we have the hammer confirming support. And even if you didn't buy on this hammer, you'd have a stop under here. Got another chance with support right by the hammer. Okay, so second secret is always use Western technicals. Here we have a bearish shooting star, and I wanted to show an intraday chart. And this was particularly potent because it was right near a resistance area. Okay, this is critical. One, correctly analyze the candlestick signal. Make sure you understand, candles correctly. There's a lot of bad information out there on the internet. So we suggest you come to our site to learn how to use candles correctly. And then remember to add Western technicals. So here we have a classic hammer, bullish engulfing pattern. Okay. If you bought, let's say, on here or here, okay, get the shooting star over here confirming a resistance area. Okay, so we got an email a little while ago from somebody who understood about what a shooting star is, and they actually saw the shooting star. They actually went bearish. They did a short trade over here on the close because it's a shooting star, and then he said, "Oh my goodness, the market rallied after the shooting star. Candles don't work." Well, I'm the first to agree candles are not perfect, but we emailed him back and explained, if you're in here and you're shooting star, your risk is really to the high of the shooting star. Yes, the market rallied a little bit, but this is a great shorting opportunity, even on the next session. Why? What is that shooting star confirming? Resistance area. So he understood the shooting star, but he didn't understand the importance of letting this trade ride to the high of the shooting star. And this is what happened after. So one, candle signal confirming that the trend is running out of steam, and two, the market stalling at resistance, confirmed with the candle signal. Okay, everybody have their thinking cap on? Little question. I was in Vegas years ago and somebody showed this. It was great. Okay, pick a card. All right. All right, everybody have the card mentally chosen? Okay. Your card is no longer there, isn't it? Okay, your card's not there. Okay, what happened? Well, what happened is you were focused on one card, not realizing they were all different. All right, so because you just focused on the one card. So what that means is that when we're looking at a trade, you may be focused on candles and Western technicals, but we always have to consider the risk reward. We have to look at the profit potential of a trade or an investment and the risk involved. Okay, so even if you have a candle signal, even if it confirms other indicators, it's not enough of a reason for a trade. You must always consider the risk reward. Okay, and the reason for that is because that will determine whether you pull the trigger or not. Okay, so which is the better signal to sell? And I made this slide a little while ago. Now my candles are green and red, but back then they were black for bearish and white for bullish. So which is a better signal to sell? Bearish engulfing pattern with this huge black real body wrapping around the white candle, or shooting star? And the answer is you really don't know, because we have to determine the risk reward, right? Here's that bearish engulfing pattern. Here's that shooting star. So the bearish engulfing pattern, think about it. If you sell here, remember, it's not a bearish engulfing pattern until the end of the session. All right, so if you're selling it here, your risk is up to here, and my target, yours might be different. My target is the recent low. But if you had a target many, many dollars lower, then it would be a fine risk reward, because price candles don't get price targets. But this would be a poor risk reward trade, whereas the shooting star, especially since it's confirming a resistance area, this is a much better risk reward trade. My target probably would not be down here anymore. It'd probably be the most recent low, which would be over here. So if we're just looking at candle signals, we might think, okay, the bearish engulfing pattern is a much better reversal signal to do a trade than a shooting star. But by looking at candles in context with risk reward, we could see that is not the case in this scenario. Okay, so here we had an email from one of our students. So why he went long. So here's where he went long. There's a bullish engulfing pattern. Okay, he was right on that. At support, okay, so it's confirming a support level, okay. There was also a trend breakout. He had drawn a resistance line, so the market did close above the resistance. So the first two things he had correct, the first two secrets. One is a candle signal showing the trend is reversing. Yes, the bullish engulfing pattern. Two, is it confirming a Western signal? Yes. Then he asked, was this a good trade that didn't work out, or did he make a mistake in judgment? I can't see. He did make a mistake in judgment. He didn't think about the risk reward. Okay, think about it. Okay, over there. Okay, so this is where he got the signal over here. This is your risk. It'd probably be a little bit lower at the top of the green candle. If you bought in the bullish engulfing pattern, your risk is here. And where would an obvious price target be? The top of the range, right? So is that a good risk reward? No. So he was right on the first two aspects, but he was not right about one of the most important aspects. The third secret is always look at the risk reward. So just wanted to give you these, three secrets, a great way to understand the nuances of candles that'll really take your trading and confidence to the next level. Okay, here's actually a trade I did a little while ago. So there was a hammer. Okay, the market was at support, but I didn't pull the trigger yet because this was not a bullish candlestick signal, right? So here, this is a little bit more advanced. It's called bull sash pattern, but this was the bottom reversal signal here, over here. So we had a support level. Even if this wasn't a hammer, it's actually a support zone down here. Even if this wasn't a hammer, it would be a support level. And the target, so you buy it here. Where do you think I placed my stop? Here? Nope, I placed it under here, right? Because wouldn't it be upsetting if the market got down to here, only holding here? So it was a very good risk reward trade, but this is a nice way of bringing it all together. The candle signal showing the prior trend is running out of steam at a support level, and a very good risk reward. So as I started to say, we've started down the path of successful education for the candles. For those who want to go to the next level, we have a great package. We have a Candlestick Express class and the Advanced Candlestick Express class. And you can see normally they're each like $250 each, but we're doing both the special price now for $295 for those who take advantage of this at the end of this live seminar, or if you're watching it on the video. And it's comprised of both the Express and the Advanced class, and 7 hours of recorded videos. And the advantage of recording videos is you get to watch it and rewatch it, take bite-sized pieces and all that. And what we always like doing, this is really popular, is include bonus quizzes to make sure you understand the material. We also give you lifetime access to this information. It's streaming. We normally only give access for a year. And again, all the strategies here work in all markets and all time frames. And if you purchase at this live seminar or at the end of the seminar, or if you're watching the video, contact Paul at candlecharts.com. He may be able to squeeze you in, and we'll invite you to a private markets of your choice webinar, where you can ask me about any U.S. markets or Forex markets that you want, and I'll give you my outlook on those markets, support or resistance, things to look out for, potential price targets, and so forth. And for some reason, if you can't make that session, you can email the market you want me to analyze, and we'll record it and send you the recording. So here's the link on top, www.candlecharts.com/bundle. So thank you so much for joining me. And Ken, thank you so much for letting me in on this great list of speakers you have. Really, really impressive. So thanks, everyone.
Well, thanks. And Steve, you're really impressive too. One of the most important things that I've learned from you in so many thousands of winning trades I've made over the last 20 years is you always say things like the price that proves the trade wrong. And one of the things that you add to the trading community that's sorely missing is exit, the thinking about how to manage or set your exits and the whole risk management, like your triad, the East, the West, and the trade management is really critical. So just learning from you how to exit correctly is one of the biggest benefits to me in making winning trades over the years. So a profound thank you, because that was a missing piece of what's the price that proves the trade wrong, and understanding how to exit in addition to the entry patterns is critically important and valuable, and Steve Nissen is the go-to guy to learn exactly how to do that. So thanks, Steve. Any last point about risk management and the price that brings the trade on? Because you're so right. I mean, I learned so much from you, so thank you.
Yeah, that's
works,
so important. Yeah, whenever I put a trade on, and what I suggest is you set your protective stop right away, because before you put a trade or an investment, especially a trade, you're much more rational. You know, you're in control, you're objective. But once the trade is on, emotions become much more involved, and you always second guess yourself. Hey, if I get out here, maybe the market will then go in my direction. You know, because we don't like to be proved wrong, our ego's involved. So exits are really, really important. You could have a potentially great trade, but you always have to monitor the trade. And exiting, risk management, I think, is one of the most important things. You know, at the end of the day, it's not how much you made, but how much you didn't lose.
Right. So, well, thanks so much, Steve Nissen. Great presentation. I picked up a lot from you too this time on evaluating the risk reward on the trade. This is new, even 20 years later, I'm still learning from Steve. So the well-run Steve, the guy knows the stuff. So highly recommend Steve Nissen at www.candlecharts.com.
Thanks, Ken.
Thanks, Steve. Well, last and not least, we've got Jeff Gibby from Metastock coming up. He's one of the nicest and hardest working guys I know in the business. Jeff, you out there?
Yeah, hey Ken, how are you? Can you hear me?
Yeah, absolutely. Coming through good. Let me make you the presenter and we will wrap up for today.
Yeah, welcome to my home office.
Looks kind of like mine. A lot of that going on here. We're at home and we're moving to Zoom next time. So no more this is our last GoToWebinar. So
cool. All right, let me know when you're ready for me to kick off. I'm pretty much ready to go here. So
we're good to go.
Let's go ahead and show this. Ken, if you let me know that people can see the screen, that would be cool.
Yeah,
it should say, finding the right strategy for you.
Good topic, and yeah, it looks good.
All right, cool. Well, in that case, let's go. I hope you're all doing well. We have a very quick session today, so I'm going to go fairly quickly. I also, being the last person, I'm pretty sure you're kind of tired by now. I'm not. I just had a double shot of like cappuccino, and I haven't done that for a minute. So anyway, I hope you're well. It's good to see you. Thanks for coming. Steve, great job earlier. Appreciate that. I haven't seen you for a while. It was good to see you kind of do a talk. And Ken, thanks for having me. The first thing I need to do is I will need to recite this. Today's demonstration is designed to instruct you on using Metastock and the accompanying software. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading, and Metastock should have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. I'll also say this, I don't have the ability to see questions as they come in, but I do want to say if you're interested or if you have questions, feel free to reach out to me directly. My email address is actually Jeffrey, jeffrey.gibby@metastock.com, and I'd be happy to answer any questions that come up through the extent of this. One of the things that you can read this if you want to. I probably won't talk a lot about this. To introduce myself, I've been working for Metastock in March. It'll be 25 years. During that time, the first decade or so was in inside sales. So there's a really good chance if you called up, 1 in 5 or 6 or 7, or depending on how many sales reps, if you called up to ask questions about Metastock, there's a good chance you'd be talking to me on the phone. For another 10 years or 12 years, I worked in business development. That's where I actually met Ken. We started doing webinars with Ken and with Steve and with a lot of the people that are here today. That was a lot of fun too. I've actually learned a lot over that 10 years. For the last 5 years, my official title has been Director of Sales, and that just means I do a lot of what I was doing before and then some more stuff on top of that, but you know how that works. I love Metastock. I've been working here since, like I said, 25 years. Just some highlights on the company. We used to be owned by Reuters. We bought ourselves back from Reuters. They became Thomson Reuters, and now they're Refinitiv. We bought ourselves back from Thomson Reuters about, well, exactly 9 years ago. And since that, we've actually kept a really good relationship with Thomson Reuters. But it's been very, very beneficial for us to have a partnership with Reuters because they do such a good job of news and information, and they're a very institutional type of a service, and that's been great. We actually at Metastock, we offer some of the best data, news, and information that's available to retail traders. In addition to that, there's like 300 markets that we cover. So I've been able to go in. We have a lot of customers in India, Australia, London, just about anywhere that you're interested in trading, whether that's stocks or futures or indices or mutual funds or whatever it might be. We'll be able to provide you the data. So if you are here from overseas, we have the data. We probably have a lot of customers in your region as well. So that's the only other thing I'm going to talk about Metastock directly. Obviously, today we're going to kind of talk a lot about system development and strategies and how Metastock can help you there. But one thing I do like to talk about is the readers of stocks and commodities for the last 28 years in a row have rated Metastock the #1 software program in its price category. That's straight. We haven't missed a year since for the last 28 years. I literally have a sales guy that we've been winning for decades. That's like 18 years old, and he's like, "Wow, that's a really long time." So, in any case, I do like to talk about that. I do think that is important.
Congratulations, that's a big win. I wasn't aware of that. That's huge. Almost 30 years, #1. That's great.
We'll get 30 for sure. All right. So today, what I'm going to talk about is trading plans. I think it's important to have a trading plan. Almost as important as having discipline in trading. I'm going to actually, to show you that, I'm going to talk a little bit about the MACD. I'm going to show you how you can use Metastock to kind of evaluate different methodologies. And then, of course, you give a special offer, of course. I do have to remember that it's a little bit faster. So I'm going to go fast, but I'll try and kind of slow down where I need to. So this is a gentleman by the name of Richard Dennis. If you're not familiar with Richard Dennis, he is one of the original turtle traders. I'm not going to kind of go through a lot of the details just because of time today, but if you go to wikipedia.com and type in Richard Dennis, you'll find out that he is one of the core turtle traders. He had a bet with a guy by the name of Bill Eckhart. They disagreed. Richard Dennis says, we're famous futures traders. We do really well at this. I can teach anybody how to trade. And Bill Eckhart's like, no, there's like a certain genetic profile, and you have to have a certain risk tolerance, and it's just things you can't teach people. And so they put together what has been probably one of the most famous competition or contests, let's say, bets, whatever you want to call it, in history. They brought in a bunch of people, they trained them, and they had basically they taught a bunch of I think it was a dozen or something. The exact numbers are on that Wikipedia article, but one of the things that it wasn't successful. It was like insanely successful in terms of the amount of return that they had. And one of the things that Richard Dennis said after that is you could publish my rules in a newspaper, but nobody would follow them. The key to trading is consistency and discipline. And if you know anything about the turtle trader method, it's a method that is in Metastock, but it is a method that very, very simply is a breakout method. So it's looking to find stocks that have broken out and buy those and put a stop loss in there. And if you've ever traded with a breakout method, you know that you're going to have some that, well, they'll break out and the sellers will come in and sell the price off, and you will have a lot of losers. And for that reason, it was very, very important that they had a lot of consistency and discipline in what they were doing. But I think it's also very, very important that when you are trading, that you trade with consistency and discipline. And we're not going to talk a lot about consistency and discipline today. We're going to talk about trading methods, but I do think that's important. The other point of that story is that they were just using a very simple methodology that they would use in a very systematic way. And since it was systematic and methodical, you could actually test it. If you don't know who this is a gentleman by the name of Gerald Appel. He is the creator of the MACD. And so today what I'm going to teach you is like how the MACD works, how you kind of use it to get signals, and how you can kind of use that in your trading. So the MACD at its heart is a trend and a momentum system. So we'll talk a little bit about how you can use it to kind of identify whether a stock is bullish or bearish, how you can look at it to find momentum in the stock. But at the heart of it, it is a trend and it's a momentum system. So, and what I'm going to do, okay, that's the end of the slideshow. We're going to go ahead and hop into MetaStock. If I could see chat, I'd actually ask you to kind of provide a symbol. But let me go ahead and we'll just type in, what's a big popular one right now? I don't know what the plug is right now, although I do have a position. Let's go ahead and just open up. The plug will be fine. Okay. And what I'm going to do is I'm just going to kind of get this white. I actually prefer white. I was working on a little bit of a project this morning for one of our partners. But what I want to do is kind of just talk a little bit about how MACD works, how it's calculated, how you can use it in a chart. And I want to do that very quickly. So if you're familiar with MACD, I'm going to go ahead and drag it on the chart. This is MetaStock right here. This is our indicator quick list. And so you can kind of see as I scroll through here, there's about 200 or 300 different indicators you can use in here. What I'm going to do is I'm going to find MACD on here. So right here, we've got MACD. I'm going to go ahead and just drag this onto the chart. And one of the things about MetaStock that I like is we've tried to kind of keep it operating the way that your Windows system is. So everything is click and pick, drag and drop, et cetera, et cetera. So if I want to put this MACD in the chart, I just find it on the list. I'm going to drag it and drop it up here. Okay. And we'll go ahead and have the MACD. I'm going to go ahead and leave the signal time periods as 9, and the color for that signal period is red. I'm going to go ahead and thicken up the line a bit though, just so you can see it a little bit better. We'll go ahead and blue. Okay. Now, one of the things I want to point out about MetaStock is there are a couple hundred indicators in here. And what I want you to kind of understand is there's a lot of information about how to kind of interpret something. So if you're new to MACD, there's an expert advisor that we're going to attach in a minute. But there's also a help file that actually kind of will talk about the MACD and what it does. So if I come in here to properties, actually, no, I went to the wrong place. If I come here and I go into MACD, go ahead and click the MACD real quick. Let's go to help. One of the things I want to do is I just get the numbers right. I think it's 12 and 26 is what I'm looking for. But I can come in here and it's a 26 period exponential moving average and a 12 period exponential moving average. It tells me kind of how it's being calculated. I'm going to show that to you. It's also going to give me interpretation parameters, tips, etc., like that, things like that. But what I'm going to do is I'm just going to grab those moving averages and throw them on the chart. So here's a 26 period. Here's a 26 period exponential moving average. We'll go ahead and click OK. And here is a 12 period exponential moving average. And we'll go ahead and say OK. I'm going to make this one a different color and a bit thicker. Again, just so you can see it. I know, like with GoToWebinar, sometimes the screen is a bit smaller. So, and then while I'm doing that, I'll go ahead and make this a little bit thicker. You'll notice it's actually pretty easy to manipulate this chart. Okay. Now I'm going to very quickly teach you 3 ways to look at MACD. Well, before we do that, let's talk about how the MACD is calculated. I'm getting ahead of my skis because I have a lot of stuff that I'm going to kind of try and go through in a way that's at least somewhat useful. This right here, this blue line, is the MACD indicator. Okay. If I wanted to calculate that, the way that Gerald Appel calculates it is he'll take the 12 period moving average and he'll subtract it from the 26 period moving average. And if I took those values, exponential moving averages, if I took those 2 values and subtracted them from each other, what I'm going to get is, in this case, the value of approximately $1.82. Okay, so that's just this shorter term moving average subtracted from a longer term moving average. Now, one of the things that kind of gets a little bit into the math of it, Gerald, when he created the MACD indicators, he didn't actually use whole numbers or moving averages. He used like 0.76 and 0.26 exponential, and I can't even explain what that means. But the closest whole numbers to those are 12 and 26. So 12 and 20. So if I take the difference between the shorter term moving average and this longer term moving average, I'm going to get a value here. Okay, if we're at a part where the stock is moving up, like it has been since, in the case of this October 6th, well, the shorter term moving average is naturally going to be closer to the price activity, and so it's going to be above the longer term moving average, like it is right here. Okay, so that's why we're kind of starting to see the MACD value getting more positive, is because we're trending up, and the faster it trends up, the more positive it's going to be. In other words, the bigger the difference between this shorter term moving average and this longer term moving average. So you can look at it, and even just looking at the value of the MACD, you can know how big the trend is, because it's going to tell you. If you're in an area that's flat, like right here on the chart, has been actually pretty flat. And you'll notice that the MACD, at least compared to kind of the future right here, or where we're at right now, was pretty flat. So it is a good way to kind of look at not only which way the stock is moving. Is it positive? Is it above zero? Is it above its signal line, which we'll talk a little bit more about in just a second. But how far is it above zero? How fast is it moving? It's a good way to kind of identify and look at momentum. Okay. This is normally where I'd say if you have questions, ask them, but I can't see them. So we'll just keep going. If you have questions, email. I'm happy to send you an email. The other line here, the red line on the chart, and I'll just go ahead and make it a little bit bigger for you, is what's called a signal line. So the blue line was the difference. The signal line is just a moving average. A 9-period exponential moving average is the default of the difference, and it's called the signal line. And the way Gerald uses it in the way that he, the method one of the 3 methods I'm going to talk about how you can use this, is you can use it as a signal line. So if the MACD is up above its signal line, which I can show you exactly where that happens. Right here, it was below its signal line. Here it went above its signal line. So as long as it's above its signal line, you're going to say that the MACD is in a bullish phase. Okay, and you can use that as a signal line. In other words, you can buy, just because in the case of plug right here, it went from bullish to bearish. Okay, so that's the first way you can look at it. Okay. And what I'm going to do here, just because it's a pretty good time to do that, is I'm going to attach what we call an expert advisor to the chart. So I'm going to go ahead and click on the expert advisor right here. And you'll be able, there are a number of different expert advisors that come as part of the platform. There's one that does candlesticks. There's one that do like trend indicators. And of course, there's one that does MACD. Okay, so I'm going to go ahead and find, it's just called MACD by Metastock. I'm going to find it in here. I'll go ahead and attach it to the chart. I'll go ahead and click on close. And you'll see right here where we went from bearish to bullish, it actually put a buy signal on the chart right here. Okay, when it went underneath, it put a sell signal on the chart. And there's a bit of a ribbon. I'm going to move this ribbon just by dragging it to where I want it to be. But you can see there's a bit of a ribbon that tells you if the MACD is in a bullish, if it's above its signal line, or if it's in a bearish phase, if it's below its signal line. Okay. In addition to that, you'll be able to see where the MACD fires off a buy signal and a sell signal, because it places that on the chart. And here you go. I mean, if we're looking here in history, this is the thing I really love about technical analysis, right? Right now, I'm not trying to guess whether or not plug is going to do well, because everybody's making electric vehicles, and Ford is going to basically switch out their inventory and do a lot more electric vehicles. And so maybe that'll be beneficial to plug in their business model. I'm not looking at that. I'm not trying to decide if there's going to be a 17th wave of the coronavirus and kind of what that's going to do to plug in general, or the economy in specific, the economy in general, or plug in specific, right? What I'm trying to do is say, okay, are people buying the stock, or are people selling the stock? And because it's objective, the software can paint it on the chart for you, right? I can see that this sell signal was absolutely terrible. Like, it would have broke even at best. This last buy signal was actually pretty good. This one was kind of terrible, right? This one was kind of terrible. And actually, most of them that we're looking at on this chart are not good. So, but I can see that because it's objective. I'm not taking guesses, okay? The second way, so let me kind of get back into topic a little bit here. The first way we're looking at MACD as a way to look at this chart is, is it the MACD bullish or bearish? Okay. The second thing that you can use MACD that I'll talk about, there's lots of different ways you can use MACD, but the second one I'm going to talk about is as an overbought or oversold oscillator. So as soon as I attach that expert, you notice right here, it started to highlight this green and this area red. Okay, and I had kind of mentioned that when MACD got overbought or oversold, you could use it as an overbought or oversold indicator. Okay, and this red, really what it's indicating is that the MACD might be at a high level. Okay, and one of the things I love about Metastock I'm going to show you quick is the commentary. So you go ahead and open up this the expert commentary window. It'll pop up. I can put this wherever I want to. This is a perfect place for it. As soon as I do that commentary window, you'll notice that there's a bit of a triangle that shows up on the chart. I'm going to go back to this one of these red bars just to kind of show you what it would have said on this day, well, or what it basically says for this day. So if I look at this, the first method I talked about was the bullish bearish crossover method. Okay, so currently using that method, we're bullish since it's trading above its signal line. MACD crossed above its signal. I'm making it a bit bigger. Above its signal line 6 periods ago. Since then, the price has increased 19.86% and has gone from a high of 34 to a low of 26. That's a range since it's been bullish. Okay. Right now, and this is why we're getting the red readings here, right now the MACD is in an overbought range. Prices may continue to move higher for some time. Wait for prices to move lower before considering any short positions. Okay, so that's basically, that's the second way we can use MACD. As if you've been trading for a while, you know that when markets get overbought or oversold, that doesn't mean they're going to necessarily turn around, right? Markets can stay overbought for years and years and years, and sometimes in some cases decades. So just because it gets overbought or oversold doesn't mean necessarily that it's going to turn around. And that's what it's trying to warn you. Wait for prices start to kind of go the other way on you. And then you'll know that that's the time to kind of consider a short position. Okay.
Hey, Jeff, I was going to say that's really, really intelligent. I'm honestly very impressed with the bearish and bullish. It would have done some little scratch trades up, down, a little flat, but they made a whole lot of money on the last one. But that bearish and bullish removes a lot of the ambiguity that even veteran traders like myself would have about, is it a bearish or bullish signal? So having that EA that does that for you, I'm really fascinated with that bearish and bullish, the green, red at the bottom. That's a huge improvement over the indicator because it gives the expert interpretation of the data that's missing, so we're not winging it. So that's a really good, well thought out. So kudos to you guys, dev team. Well done.
Yeah, and one of the things that I could also kind of just add to that for real quickly is this is just the MACD one, right? I could attach the candlesticks and it would identify different candle patterns for 30 different patterns, or it would analyze Bollinger Bands. So this is just an idea to kind of help us learn just this indicator. The last thing that it looks for, and this is one of the ones I'm going to go real quick on just because, well, because of the time, but the last thing it looks for is divergence. And I'm going to kind of go fast on it, but I do want to say that one of the people that I really like in the market, in addition to Ken, of course, but one of the people that I listen to a lot.
Too kind. Thanks.
Yeah, is Dr. Alexander Elder, who wrote Come Into My Trading Room. One of the things that he looks for is called MACD divergence, and is the third way that this will look for. It hasn't had a divergent signal within the last 5 days. If it noticed a divergent signal, it would tell you. But Alex actually calls MACD divergence the most powerful signal in all of technical analysis. Now, the way that you would look for MACD divergence manually on a chart using the Alexander way is if I was to draw it right here, we've got, I'm going to just grab my trend line tool on Metastock. Right here, we've got a peak in MACD followed by a move below zero, followed by another peak. Okay, so I could draw a line connecting those two peaks, and you've got a generally upward drifting MACD. Okay. If I was going to look for look at the price activity during that time, you'll notice that this is going up a bit and this is going down a bit. That actually is a divergence. So it might be giving us another indication that it might be kind of time for me to be a little bit more defensive in my position on plug, because I actually do own a position on plug right now. But right now, this is a powerful bearish divergence signal. This is what Alexander Elder would actually be calling breaking the back of the bulls. So I might actually kind of look at my stop and see where that's at tomorrow, but that's how you look at it. Now, I'm going to spend about maybe 10 or 15 minutes talking about MACD and explaining how it works and, you know, that kind of stuff. The thing is the only reason I chose MACD for this example is when I created this lesson, the MACD kind of the lesson that we had on YouTube, youtube.com/Metastock, was the most popular lesson we had up there was on MACD. I could have picked any of the 200 indicators or the 40 different systems. What I want to get across is this actually probably, if I did go in and say, if I bought here, and if I sold here, I bought here, I definitely would have made money, right? This would have been a break even. I could go in and figure out exactly how profitable this is if I wanted to trade Plug or Apple or IBM or whatever it is. But from a perspective of if I'm a new trader, or how do I know that this is one that I want to spend 15 minutes learning about, right? And for that, because everything's objective, it's not subjective, I can explain to you how we're getting the signals on the chart. I can test this and I can compare it to some of the other different expert signals that are in Metastock. So for the purpose of time right now, we're just going to show you a real quick system test. What I'm going to do is I'm going to open up our Metastock Power Console. I'm going to go ahead and go into the system tester. Okay. And I'm just going to select a bunch of these. I don't want to do, yeah, we'll do all of them, but we'll do just Plug. I could do more than one security as well, but let's just say for the purposes of time, if I just wanted to trade Plug using these 75 different methods, which one would actually work best for me? And I'm going to only do long trades and short trades. I'll do both. I'm only going to go back a year just for time. And I'm going to start with what's in here. I'm going to start with $10,000. Yeah, and we'll trade as a percentage of the available equity. If we had a little bit more time, I'd show you how to set all the options, but you can set this up any way that you want. Let's go ahead and run the system test. It's going to run 678 different tests, and you'll notice that it's going to do moving average penetrations. It's going to do MACD. Right now, it's working on the LCI system with optimization that's already done. But it's going to go through all the different built-in methods that are available for Metastock and tell me if I was just trading Plug last year, which of those methods would have made money, how much they would have made, what are profit and loss, how often they traded, all of that stuff is going to be done. So, and it's about 90% done. And now I can just look at the reports for that. So if I go into view reports here, let's see, let's go ahead and kind of move this around. These green systems right here are the ones that made money last year. Okay, now because this is powered by Refinitiv data, you could go back to 1980 and you can test from 1980 to today if you wanted to. You can just test a bullish market or a bearish market. You could test just one instrument, which is what we did, or you could test all the S&P 500. So in this particular case, though, the best performing system is the Mama Fama system. Over the last year, it made 188% on 13 trades. And I could come in here, I'm running out of time. So there is a full report that I could kind of look at. I could see what my drawdowns would look like, how many times it traded, all that kind of stuff. But it allows me to kind of evaluate, because there's so many different ways to trade out there. Which ones have the right performance style for me, right? How often is it trading? I'm very busy at work. I have, depending on the day, 2 to 4 kids around here. So it just kind of, how do I determine kind of what the risk reward looks like? What does the equity look like? How do I find the right fit for me? And then we can kind of spend our time learning about if this is the right system for us, the Mama Fama system. So that's a little bit of an introduction to Metastock. System testing is a huge part of what it can do. It can also do scanning. You can do explorations with it. I run a scan every market day because I want to be able to, I usually typically scan just the S&P 500, but I want to find the ones that I want to buy today. And I want to ignore all the other stuff. I don't have time to look at stocks that don't have an opportunity for me to buy. And that's one of the things I love about it too. So you got the system testing, you've got the scanning, you've got the expert advisor that can kind of explain all those systems to you. We do have a patented forecaster that I didn't even talk about. But so for the pricing for Metastock, we have 2 versions. We've got the Metastock Real Time. It's $250 per month. And that includes Metastock. It also includes a program called Zenith, which is a news and fundamental product that is supported by 3,000 different reporters and 300 different news bureaus, has fundamental information. It's a very, very similar product to something that you'd get if you were bank or a hedge fund looking for really good information. Literally, it's a Bloomberg competitor. That's $250 per month. We also have an end of day version that just includes Metastock. It's $69 per month. That includes Metastock and all of the data that you need to run it. A special that we're going to do is we're going to give you what we call an extended trial, where you can buy a month and you'll get your second and third month for free. So basically, for about $23, $24 a month, if you do the end of day version, you can try Metastock and you'll be running, let's see, it's November, December into 2022. So I'd encourage you to try it. That'll include Metastock 17. It'll include data. We'll actually have somebody that calls you. We'll set up a time. They will help you install the program and walk you through all of the tools that I had a chance to talk about and all the tools we didn't have a chance to talk. And we'll also give you a little bit of a home study course that kind of walks you through everything as well. So you can sign up for this at metastock.com/DTUB. You can give us a call at 800-882-3040. And we also actually have people working today. If you have questions and you want to ask them, go to metastock.com/sales-chat. Edward and David are both happy to answer any questions you might have. They're both in here on their Saturday working. So in terms of that, if you have questions for me, email me, jeffrey.gibby@metastock.com. I want to say, oh, perfect time. I want to say, Ken, thanks for coming or having me today. I hope you guys enjoyed the presentation. Give Metastock a try. I absolutely love it. I wouldn't be able to trade without it. I love working for the company for the last 25 years. And not only has it helped me, I owe everything to Metastock, right? But I don't think you should, I don't think you should not try it. I think it's something that would be helpful for you. And if it isn't, well, it's $69 to try it for 3 months and make sure it isn't. So the risk reward there is there. The risk reward there is there. Yeah, give us a call. All right, Ken.
All right, thanks so much, Jeff. Outstanding presentation. And by the way, on your plug example, there's a shooting star yielding a sell signal on Thursday, a loss of the low. So the Candlesticks would have told you to sell your plug on Friday. So anyway, outstanding chart. Of all the charting software in the world, Metastock is absolutely hands down the most complete. That gives you more options and more choices and more in-depth analysis. And I'm totally impressed with that EA. That's new to me, man, but I would use that because it would have made me money on the plug. So appreciate it. It's an outstanding chart software. I've been using it for years to do the webinars with Jeff, and I wanted to say thanks for being here, man. I appreciate it.
Of course, Ken. Thanks for having me. See you soon.
All right, thanks. All right, traders, we are just about ready to wrap up. I'm going to close things off here with just a minute. I wanted to say thanks to all of you for being here. We will get hopefully the video recording will come out good, and we will get that to you shortly via email. I do encourage you to try out all the different presenters' offerings. They're all world-class experts, and they know what they're talking about. Unlike a lot of the webinars that have the people that don't, I like to have the world's top traders and the people that have resources to help everyone. So I wanted to thank all of you for being here. Let me end up with one last thing here. I want you to go to tradingjazz.com. Tradingjazz.com. And just for fun, I'm going to play a little bit of tenor sax for you guys. You guys can take off if you want, but if you want to hear a little jazz, I'm only going to play for 2 or 3 minutes, but I thought it might be fun. Look at a lot of the videos I have recorded. They're really good at tradingjazz.com, TRADINGJAZZ.com. Let me get the horn. I'll be with you guys in a minute. But you guys have been great. So many hundreds of you here. I wanted to thank all of you for taking time out of your Saturday to join us. A little jazz coming right up. I've got a Yamaha 62 purple logo, classic tenor that's got a really nice sound. Hopefully you guys can hear this. Thanks for being here. It's been a real long day, but a really good one. I learned a lot. Let me put this back. That's it for my tenor. I was going to put the camera on, but I decided not to because I'm looking tired. Hopefully you guys had a great time today, and thank you so much for being here. Appreciate it. And I will see you guys next time. It's been a real good session, right? I picked up something from everyone, so that's always good. Some really smart ideas, and hopefully you guys will do well in your own trades as well. So I'm Ken Calhoun from TradeMastery.com, wishing you all the best for successful trading in the upcoming weeks ahead. So take care, trade smart, and I'll see you next time. And I will try and get a video out, so give me a couple of days to get it all wrapped up because I gotta get it all cleaned up and everything. So watch for that, and do visit all of our speakers, including myself, and try us out, right? Hopefully we can add value and help you make bigger winning trades more often, a way of life.